The 2020s will be a time for entrepreneurial mindsets and creative solutions. Never has there been a generation where so many new technologies and capabilities have come to market so fast, changing lifestyle trends and business expectations almost overnight. Qatar Post's mission to provide leading postal and logistics services in the digital era has led to world-class innovation.
We focus on 4 pillars: technology, people, customer, and the processes. We have 2 platforms that give Qatari customer easy access to shopping, Turkish Souk and Connected. We aim to give our people the right skill to operate in a more customer-focused environment. We must operate at a global level as Qatar is located as a strategic hub.
This age of innovation has led to exciting startups changing ecosystems like Snoonu, the fastest delivery app in Qatar, linking thousands of people to their favorite shops, groceries and restaurants.
Snoonu is a super app that can deliver anything the customer wants online, and also a full solution for business owner, a fulfillment center, and a data analyst of what his business is doing. We applied a lot of artificial intelligence and machine learning in our technology that can help us to manage what we call it a crunch mode. In crunch mode, we even start managing our time of delivery, merging some deliveries. We are helping the customer to decide what he wants by applying a personalized experience in our applications.
A SARS-like virus which has infected hundreds in China.
COVID-19 is spreading faster in India.
Europe is now the epicenter.
The UK tonight acknowledged it's losing its battle.
And more than 3 million people have died.
Has now reached the United States.
Kingdom has become the first country to approve the Pfizer coronavirus vaccine.
The coronavirus pandemic has tanked the global economy.
It's worse for a single quarter than we ever saw during the Great Recession.
4.4 million people filing for initial jobless claims.
Around 50 countries have begun vaccination programs against COVID-19.
Other countries will have to wait a while longer.
Outrage at the death of George Floyd.
Demonstrations, riots, and violence from coast to coast.
The events in Washington have taken a violent and tumultuous turn.
Israeli airstrikes flattened 3 apartment buildings in Gaza City.
Administration's ambitious climate agenda. The change here is just monumental.
Coast to coast, signs of reopening.
Hundreds of families separated by COVID-19 were reunited at last.
Hello.
Hello and welcome to the Qatar Economic Forum powered by Bloomberg. The world reeled, millions died, and economies crashed. The pandemic sparked the worst financial crisis in recent history. Today, we focus on how the world of finance is going to power the global economic recovery. There are three main hurdles. First, the level of global debt has reached a record of 281 trillion. That's 355% of the global GDP. Two, some countries are still battling recurring waves of the virus. And three, the global unemployment rate. As the world navigates its way out of the pandemic, capital spending is expected to increase significantly. Here's Bloomberg's Francine Lacroix with two of the world's top investors on where they're putting their money.
I'm Francine Lacroix, and I couldn't be more happy to bring you this panel on investing for a new age. So we're speaking to two top investors, really, to try and figure out the global market outlook for the year ahead and beyond. I couldn't be more happy to now welcome to the stage His Excellency Mansour bin Ibrahim Al Mahmoud, Chief Executive Officer at the QIA, and Stephen Schwarzman, Chairman, CEO, and co-founder of Blackstone. So gentlemen, thank you so much for joining me. We have 24 minutes to figure out the investing landscape in the next year and beyond. So a very simple and difficult question. Your Excellency, how has the pandemic actually changed the way you look at investments going forward?
Of course, the pandemic has changed the landscape of the investment. As you know, during the pandemic, a lot of consumer behavior has changed. Government have increased their spending. Businesses have changed their businesses in order to maneuver the crisis. So a lot of changes happening in the landscape. From a sectorial point of view, also, as you notice, some sectors has performed very well, and some of them are not. And within the segment of each sectors, there is some elements and the trend that has performed very well. And as a financial institution like us, we tend to really analyze the sector and try to identify the future trend that might change and try to deploy investment in promising opportunities. For example, we have invested heavily in technologies. In particular, for example, we have been deploying investment in online education. And this is something that we have deployed before the pandemic. And I give a credit to the team who have identified this future insight on that particular sector. So the pandemic have changed the landscape, but our philosophy remains the same. We remain as a long-term investors. We remain to really invest for purposes in a very diversified way.
Thank you so much. Steve, how do you see it changing?
Well, I think we're very much on the same page as QIA. We've seen just astonishing acceleration of trends. This is the world of disruption that we've experienced, and technology is the way to play that. So we've been fortunate that we made that pivot before the pandemic itself. And we've done all kinds of things to take care of, address that kind of digital acceleration. So, for example, we decided really close to a decade ago to emphasize warehouses, which are needed by the digital economy to ship things because they ultimately have to be delivered. And we've switched our real estate portfolio over time away from hotels and malls to life science type of investing and warehouses. There are no vacancies in those types of businesses in real estate, and big acceleration of rents. So we see these trends as enduring. Disruption now is something that every business's business model is being challenged. And the pandemic really brought that home. And so we're investing a lot in technology and green investments and all types of things that are reflective of the world that we're now living in. Much more growth investing over time. We call these good neighborhoods. And so we're very much thematic investors. And that's turned out to be really a wonderful approach for generating performance with capital preservation.
Your Excellency, you also were talking about trends being brought forward because of the pandemic. What about real estate? So does that change? Will we work more from home? Does it actually change some of your investments in some of the biggest capitals in the world?
Absolutely. As you know, real estate is one of our traditional asset classes, and it takes a component in our mix. Absolutely, when you see the pandemic has brought a subject between how the e-commerce will really impact the retail space, and this is challenging for the segment of the real estate. Working from home for the offices is also something that is changing, even though I'm a really believer that people will keen to go back to their offices, and I'm glad Blackstone have started to go back to their offices. But we are focusing within real estate on very sub-segment. One of them I'm sharing with Steve, the theme of investing in warehousing to really support the e-commerce businesses, which is a segment that we are deploying big time on that. The data center, for example, which is another segment that we think have a promising future, and very specific real estate. We appreciate the relationship with the Blackstone, and we have done co-investment opportunities in life science real estate, which is something used for research and labs on that domain. So you have to be a little bit very specific in analyzing the sector and try to really find out what are the opportunities that you need to really deploy investment on.
Steve, are you aggressively now on the hunt for deals, and do you worry that multiples are just very high, and that will, mean it more difficult to find the right companies, the right opportunities along the road in the next 12 to 18 months?
Well, I think, Francine, you're right on point with that question. We've been in business almost 36 years, and so we've been through these periods of higher multiples. And it leads to a certain type of caution, but it also presents a lot more opportunities because prices are higher, more people will sell. What we've learned is because we're fundamentally in the private markets, is that the only reason to buy something is to make it much better. We're in the business of accelerating growth of companies and of real estate that we own. And so it's unlike stock investing where you buy it and you hope it works out. We're change agents, we believe for good. And if we can put more money to grow businesses, then we can deal with some of the issues of higher prices by accelerating growth, which gives us more protection on the downside. With the prospect of the United States potentially increasing capital gains taxes very significantly, it's really like an avalanche now of opportunities of people want to sell things before their taxes are much higher for selling the same thing potentially next year. And so it's giving us a lot of opportunities. And what we have to do is be careful, always have a very exciting plan for growth. By the way, that results in us hiring more people. So this is good for society, and hopefully it's good for our clients who typically are large institutions like QIA.
Your Excellency, how far along is the QIA in actually try to diversify its portfolio? So I know you've planned to boost investments, for example, in technology and healthcare. Is that done to a level that you're satisfied with now?
Not yet. I think we have been deploying and focusing in technology and healthcare. Within the last 2 years, we have deployed in technologies more than ever before. I think the sector is promising, especially if you really targeted a certain segment within technologies. And I think it's the sector is have grown to stay. I don't think so. There is a risk, perhaps in the short term, with the inflation in mind. Even though I'm not really concerned about it, I think it would be a temporary basis. But as you know, it's the era of technologies, and a portfolio without a huge component of technology is not really a balanced portfolio.
Steve, I was also going to ask about inflation. Is there a danger that the U.S. economy actually overheats?
I think there is a danger. The U.S. economy is really on fire. Almost everything is growing much faster than almost anyone anticipated. We've had almost a perfect storm here of massive government spending, central bank accommodation, record low interest rates, and that's a recipe to really power an economy. In the United States, for example, we're looking at economic growth of estimates around 8% real. We're an economy that usually grew 2.5. When you go up to 8%, you are going to create all kinds of interesting things, one of which will be inflation, which we're experiencing now. This isn't a future concern. It's right on point, whether it's commodities like lumber or copper, anything that's used in housing. Wages are the most concerning because we did some things in terms of our stimulus plan with very large benefits for people and extended them, which was prudent at the time, but has turned out to be discouraging workers from going to work. So we have 9 million jobs unfilled and 8 million unemployed people. And we hope they're matching up, but it doesn't look like exactly they are. So some of this will be temporary as the economy starts up again and things sync up, not 100%. So there'll be shortages, people bidding up to get certain types of commodities or other products. But some of them, once you raise people's compensation to get them working in hotels or theme parks or other types of things, it's very difficult to reduce people's compensation. So I think some of the inflation will be baked in at higher levels than we've certainly experienced the last decade.
Your Excellency, do you agree with that? You seem to suggest that actually the kind of inflation that we'll get will be transitory. So what does it mean for your investments?
We mean this is, less risky for us. It doesn't mean that we are not monitoring the situation very closely, but we have a full confidence on the Federal Reserve in managing this, and they have proven that they have managed the pandemic time very well. And we are hoping that we will have a soft landing and managing the inflation.
Your Excellency, for a long time, the QIA was really associated with the so-called trophy investments, be it Barclays or Harrods and the LSE. Has that now changed? Is it a change in policy or investment strategy, or could we see big ticket investments coming back?
You could see we always believe in diversification, and any exposure in any region we always try to maintain a part of it real estate, part of it with the blue chip companies and some technology company. We always believe in diversification and have a great balance and mix that would manage our risk. So perhaps when we have an opportunities, you might hear us, acquire some businesses in the future.
Which, I mean, if you want to share the names now or something that you're potentially looking at, but probably not.
No, of course I cannot. Of course I cannot share any names.
Steve, there's such big amount of money, of dry powder in PE firms. Does it mean that we could be looking at new asset classes, that there are maybe even regionally parts in the world that were lagging that now can see a deployment of capital?
Well, what happens is there's always a lot of capital available for people who have high returns in the private equity sector, and basically the alternative assets have had superior performance over time, and there's more money. And what you look to do is not put all that money in the same strategy, because then you would end up with lower performance. So there's a constant search for new things to do that you believe would be good for your investors. And if you can't find those good new things, then you just don't go there. But we're finding that there are different rates of return that different investors want. And so we're doing more investing now around the world with rates of return that make retail investors very happy. Those may be somewhat different, with more emphasis on current income than a sovereign fund like QIA may be looking for. And what we're finding is there's huge demand for current income with returns in the 10% area, and we're expanding rapidly around the world, providing that types of returns. Ironically, it ends up being a good thing for the higher return products as well, because sometimes we can buy a very, very large investment and break it into two pieces where it satisfies the needs of both of those different return funds. So we're finding global expansion is very much comfortable for us. We've got 28 offices around the world, and we're always finding something new to do, which, by the way, keeps me excited about what we're doing. It's always something new where we think we can develop very high returns or appropriate returns for investors.
And the QIA also had this pivot to Asia, or this tilt towards Asia. How is that going?
Absolutely. I mean, Asia, we have been very vocal about Asia and US. And we have been very vocal that we had a little bit of concentration in Europe, and we have been deploying for the last 2 years, mainly in Asia and US. So it's going fantastic, and most of our pipeline is dominated for these both regions.
Steve, how should we look and how should we think about sustainability? So there's definitely been a pivot towards more ESG factors when investing, more sustainability, especially in the last 14 to 16 months. Are we going to rebuild an economy based on that? And what does it mean for investors?
I'll get to that in a second, but I just wanted to finish up what Mansour was talking about. Our largest returns in the world, our best returns historically have been from India, which is an Asian economy. So as he's saying, he's putting more money there. We found that's a very wise thing to be doing. As to sustainability, this is a trend that's been going on for some time. We hired a chief sustainability officer at Blackstone 10 years ago. And it will be a large part of the energy area. Of course, the world is pivoting in that direction. In the last year, we've invested $5 billion in those types of green technologies. There's a global focus on clean energy sustainability, and every business needs a focus there. I think, Francine, you're right that this is a new vertical in the investment world, and it's a good thing that it's happening.
Your Excellency, I wanted, before we get on to sustainability, which I know is something that you're also looking at very closely, do you have a target for investments in the US and investments in Asia over the next 5 years?
Yes, we have a certain allocation and exposure that we normally present to our board, how much we would like to invest in Asia, how much we would like to invest in the US. Hopefully, I mean, your pipeline and your finding opportunities will dedicate also how much you are deploying this. Some, as you know, some of our investment is also managed by a third party, like, for example, Blackstone. And we are trying to associate ourselves with the best-in-class asset management because we believe they are the engine of any economy and they are a generator of a lot of deals that will make us really or present us a co-investment opportunities to deploy more investment on that region.
Do you ever worry about being caught in the middle of a U.S.-China, trade war, or not getting, any easier?
I don't think so. I think the subject will remain for a long term. I mean, there is a fundamental issue between the two countries, and the subject will always remain. We are monitoring the situation very, very closely. And I think the two countries are mature enough to understand their consequences if there is any major disagreement. But apparently, the negotiation will take longer than expected.
How do you see this developing, Steve? And then I do want to go back to ESG, but how do you see the relationship between the US and China developing under President Biden?
Well, you have to start out with the fact that the US and China together are approximately 40% of the world's economy. And there are only two countries out of roughly about 185 countries. So you have about 1% of the countries with 40% of the global economy. So there's a need for these two countries to cooperate in a variety of areas, setting up completely separated economies is really impractical. There are certain areas that are of enormous sensitivity between the two countries, which are mostly around technology. And I think that will remain as an area of focus between the two countries. There'll be more development of independent sourcing in that area. And I would anticipate that a lot of the other commerce will continue, much as it is doing currently, by the way.
How does the QIA actually look at purposeful investing? And what can you tell us about the energy transition? How do you see it playing out?
I mean, our philosophy, as I mentioned, it is investing with a purpose. And we're always satisfied when we invest something that it makes a return, it brings positivity to the market that we are investing in, and which is environmentally friendly. We have been investing in the ESG initiatives and the project for quite a time. But this year, it would be a little bit institutionalize our process, and we will embed our ESG into our investment process. We will have a policy, we will have a KPI. I think ESG is getting very important, and I think the momentum globally is there. Investors are looking to deploy investment. And government, from the other side, are being very receptive. Both parties are admitting that we have an issue globally, And I think there is a momentum and there is a tremendous opportunities in that space. Even within the technology that's supporting that space is tremendous. For example, we have been investing in energy storage facilities, and we think this sort of investment will help deploying more investment in renewable energy.
So we're almost out of time, but in 30 seconds, Steve, when you look at what you think investors get the most wrong, is it SPACs, cryptocurrencies, or is it the abundant liquidity in the market?
Geez, you have some really fascinating recent developments. There was several SPACs a day being created, and now there are almost none because the regulators have gotten involved, and some of those compensation arrangements for general partners were somewhat inconsistent with alignment with some of their investors. So I think that was an interesting thing where you have a lot of capital now looking for deals. As to cryptocurrencies, I leave that to Elon Musk.
All right, what about you, Your Excellency? What do you think the markets get wrong?
I think both subjects are premature, and they need time to reach maturities in terms of legislation that govern them. In terms of a SPAC, we have been dealing with them from the receiving end. So some of our investment has been targeted by SPAC, and it went very well. In terms of the cryptocurrency, we have not. We think we are. That space is in a speculation space right now, and it needs a little bit of maturities until we make our view about investing in that space.
Gentlemen, thank you both for a very spirited conversation.
Hello, and welcome to this session on powering global finance. We have two great panelists here, Axel Weber, chairman of the board of directors at UBS and former head of the German Bundesbank, and His Excellency Sheikh Abdullah bin Saud Al Thani, the governor of the Qatar Central Bank. Axel, first question to you. What is the key risk? We've all this week at this Qatar Economic Forum been thinking about the risk coming down the track for the global economy, as well as the opportunities and some exciting new markets and challenges for business. But you're someone I would want to ask about the key risk facing the global economy today, and particularly whether central banks should be more concerned about it.
Well, I think almost no forecasts show any downside risk for the next, I would say, 3 to 5 quarters. We're seeing a very good start of the year. We'll see a bummer second half. It will only slowly go back globally to an average of growth to 3 or 4%, the usual range. But the difficulty will come from a recovery to a sort of normalization, a big part of the cycle already within 1.5 years. There's almost nobody sees downside risks to inflation, all see upside risk. And I think some of the nervousness around the central bank community, you can clearly see, because whilst they all sit on the mantra that these rises in inflation will be transitory, you actually start seeing, for example, in the Federal Reserve, that members of the committee are worrying more about inflation than they did in the March meeting. Actually, there's a record number since they published the dot diagrams that says they have a worry about inflation risk being on the upside. And that is something that they need to monitor very closely. The risk is that the coming back of the economy, that the normalization in prices combined with bottlenecks and base effects will lead to inflation readings we've not been used to for a decade or two. And that may unnerve some investors and consumers. And you need to monitor it very closely so it doesn't become ingrained and embedded in wage price dynamics. We're already seeing positive price dynamics as a result of bottlenecks. If wage demand continues to fall in line with that, there's a risk that this might become more sustained than just transitory. And that's really the risk everyone's focusing on. I see the nervousness in the central bank community really starting to come up.
And just to come back briefly on that, I guess there's two issues here. There's whether the global economy is looking to an era in which there's somewhat more inflation than there's been in the last 10 years, but also whether there's a specific issue around the US and the US potentially compounding the problem with its stimulus. So I'm interested, given your background at the Bundesbank and other places. We spoke to Larry Summers earlier this week for this forum. He has said he thinks that the US macro policies at the moment are the most irresponsible they've been in 40 years. Do you agree with that?
They're definitely the most expansionary they've been in decades. The US had a massive fiscal stimulus. Monetary policy actually hasn't been as expansionary when you look at the balance sheet alone as, for example, the ECB. But look, it's an unusual environment if people like Larry Summers, Olivier Blanchard, or Paul Krugman are on the same warning side as I have been traditionally on warning about inflation risk. So I think both the economists, a community that always advocated massive stimulus, both fiscal and monetary, is getting a bit nervous this time around that we might have overdone it. And I think that first and foremost holds for the US. But there's also a broader issue on there's going to be very mixed signals. And this is a once in a decade or century event. And it's very hard to calibrate this against our models from the past. So I am concerned about inflation overshooting by more and for longer than is currently being priced in inflation forecasts of central banks. They're notoriously unreliable when it comes to medium to longer term inflation trends. And I'm also worried that we'll see a second half of the year where the economy is running really hot, first and foremost the US economy, and that will have spillover and spillback effects into the global economy. The ones that are really at a very difficult point are emerging markets, because the US might tighten and impact on their environment before they actually fully recover. So I think the fallout this time around is more focused on the emerging market spillovers of a premature or even of a late tightening in the US, because it will have effect on certain countries.
Well, that's a very good note on which to bring in Your Excellency, Governor Al-Thani. Are you concerned that the US is cooking up an inflation problem which is going to destabilize the recovery and potentially down the road pose real challenges to emerging market economies?
Yes, thank you. I don't think there is a risk of inflation. We have seen recovery, fast recovery after COVID-19, and that has created some kind of demand pull. Therefore, I think that's also some government has also increased their expenditure. And the vaccination and the recovering, which we have seen in the last period after COVID now, we see a very strong demand pull, which can create some kind of temporary inflation. But in the long term, I don't think there is something to, now we cannot anticipate whether there is an inflation or not. But let me tell you, there is a long term. For the last almost decade, we have seen a lower interest rate. This is the only things which we are worried about it, because we have seen some investors has been investing in a very high yield, risky investment, and the borrowers has been very comfort for a certain period of time at a lower interest rate. So I think this is the things which we have to worry about it for the future, in case there is some kind of temporary inflationary effect. But I don't think there is something. Yes, we might see some kind of pressures from the supply side, which cannot meet the demand. And this is, I don't think, something which we are seeing it's a risk, but it's a temporary inflation.
And Qatar has a peg to the US dollar, which protects you from some of the issues that emerging market economies would face, but also clearly has some drawbacks. Could you imagine moving towards a more flexible regime, or maybe needing to, due to the effect on the dollar of these policies?
No, I don't think we will change our regime at this moment. There is no need, but definitely the recovery and the growth, which we have seen in our GDP, which we expect this year will be positive, and we have seen it in so many countries. This is something will create some kind of inflationary, but it is not going to be something to worry about it, that we have to change the regime. I think historical, for us, we are linked to the price of oil, and the price of oil, and the inflation. For us, inflation and the fixed exchange rate regime is really it's an added value, and it's also mitigating a lot of risk, which we don't think we have to change the regime, because this is only cyclical times, and I think the fixed exchange rate it's done their homework for our country.
We've talked a little bit this week, Axel Weber, about the role of the dollar, and also just what the implications are for the dollar of the policies the US is pursuing. I think economists could argue it both ways. You could say that the very loose policy would suck in a lot of imports and push the dollar up. But if people feel that it's a very irresponsible set of policies, you could imagine down the track a crisis or a run on the dollar. So where do you stand on that?
Look, I think there's no dispute. These were extraordinary times, and in extraordinary times, you need extraordinary measures. So the timely provision of fiscal stimulus in the US was the right decision. I'm not talking about the size, but I'm talking about the timeliness. On the size, you can easily argue, but I think you need to look at the combined monetary and fiscal policy response. And in the US, we've seen something that we complained about in the last crisis, that it wasn't there, namely a very early and strong fiscal response, and monetary policy compared to Europe was more muted. In Europe, it was the other way around, less room for fiscal policy to move, so the central bank responded in more of a way. That has helped us to come out with a vengeance of this crisis. Now, looking forward, what is important is we phase out these policies as the economy heats up or might actually overheat in the United States. And that's going to be the big debate. If central banks feel that inflation pressures force them to move rates, will that be happening under negative commentary from policymakers? Will there be pushback? And will they be able to do what is needed from a monetary policy perspective, because there is this big debt overhang that has been created and needs to be financed? So I think there's going to be more tension around normalization than last time around, where the fiscal response wasn't as bold, and therefore the withdrawal of that fiscal stimulus with all the effects that will come in terms of next year, we'll see fiscal cliff effects as that policy is faded out, and monetary policy might just have to tighten against the background of negative fiscal effects coming in, and these cliff effects will make the discussion on normalization harder. The Fed exited from zero interest rate last time around and did actually change interest rates and reduce them coming into this crisis, so that helped. They need to provide themselves with that room again once we actually have the economy run on all cylinders, and that will be the case by the end of the year. They should not delay tapering and tightening decisions too long, and I think they're starting with the balance sheet to basically park that at no increase. It'll happen over the autumn. Probably we'll hear the Federal Reserve in October talk about that, and the Europeans need to follow course, maybe somewhat later. But the combination of the two policies matters.
And just to push back, I mean, I think in Europe particularly, you're right that the key challenge is going to be managing that transition and indeed building up some further room for policy maneuver on the part of central banks as they come out of this. But that's a very difficult thing to do when you have many European countries actually dependent on the low cost of financing for their public finances remaining in order. There seems like there's a linkage there which is much greater perhaps than it's been in previous times. Countries like Italy, very dependent on these continuing low rates?
Yeah, that's true.
Axel.
But don't forget, there is also a new generation European fund, which is quite sizable, which will actually start issuing European debt with prices around that European debt. The expectation is Europe will have to pay more than Germany to indebt itself in the market. But there's going to be a different instrument in the market, even so it's not huge, where the central bank can look at what is the average European debt that is issued and what does that cost in the market. And that will give it a different parameter in looking at countries' performance relative to the European performance, which is the average. So monetary policy is not going to be as driven, in my perception, by national discussions about their financing cost in the market, and will be able to focus a lot more on the cost of the European level financing in the market, and then make the spread relative to these European debt instruments a matter of national concern and fiscal policy as opposed to monetary policy. So that will help. And in my view, the question is, how large is that premium going to be that the Europeans have to pay over Germany getting in debt, and how much is sort of the discount at which they can issue relative to countries like Italy. But that's naturally then a discussion of national preferences relative to that European average. I think that's why, despite all the shortcomings and problems that this new generation funding has, it has some positive side effects on financial markets.
Governor Altani, you mentioned the oil price. It's around $75 a barrel now, but that's still well below where it got to in 2014. And we've seen GCC countries, Bahrain, Oman, have their balance sheets quite severely affected by that. Are you concerned about that impact? And do you think it's part of your role as a regional leader that Qatar should intervene and support Oman, for example?
Well, maybe I will speak about Qatar's. We this year we budgeted the budget for at the price of 40, and if it's 75, I think this is a very good things for our economy. I think we don't know the other country how they are really affected. But definitely, we believe that 75 for us is good. We are almost now halfway of the year above. So we are looking to see the price will be stable until the end of the year. And this is a very important. I don't know about the others, so I think we are just getting from COVID-19, and also, as you know, we have also before that we have some kind of siege and blockade. So it's very important that we are also reorganize our monetary and fiscal policy for any challenge which comes in the future.
But would you see yourself, just to go back a little bit on my question, would you see your role in the region as one of potentially offering support for other GCC countries that are entering difficulties, who might otherwise face a very tough combination of policies to get their house in order?
I think that's always done through the Ministry of Finance, mostly in their meeting. In the GCC, and they discuss this matter, So this, I think, the financing between countries, and it's not in the agenda of the governors of the central bank mostly,
Well, that's the right answer from a disciplined central bank governor. Just a final one, which is more about the things that we might be talking about in the future when we talk about powering global finance. Digital currencies, crypto has obviously been a huge subject in the markets over the last few months, and something that's also going out into what one finds, taxi drivers and people you meet everywhere have suddenly discovered different cryptocurrencies. I mean, Axel, do you think that this is something that's A, here to stay, or B, something that poses a risk to the global financial system, or makes us want to change regulation, change the way we think even about central banking?
it's not yet big enough to pose a risk to global financial stability, but it's big enough to pose a risk for individual investors that invest in it. I think central banks will not allow any other form of anonymous means of payments outside cash. They will develop tokenized payment opportunities themselves. There's already a pretty widespread means of payments that we have in the private sector. So the technology that is behind that, that technology will play a big role in all segments of financial market. Blockchain technology, I think, is here to stay for good. Digital currencies, tokens are here to stay for good for special purposes. Cryptocurrencies, I think, lack a underlying rationale. They're not a good means of payment. They're not generally accepted. They're not a store of value. And so they don't fulfill the typical functions that you have with cash. They might be an exciting investment about it. I often call it crypto tulips, but that's a risk that individual investors take. It's their choice, but it shouldn't become big enough to be a risk to global markets. And it's definitely not a replacement of fiat money and other means of payments provided by the private sector or by central banks.
We often find that people who say these things still hold quite a lot of Bitcoin. I should ask you, Axel, do you have any Bitcoin?
No, I have Swiss francs and euros, and I don't hold a single Bitcoin, and I don't think I ever will.
Governor Al-Thani, how do you see the role of cryptocurrencies and digital currencies in the future? As a central bank, is it something that you're thinking about very closely?
I think digital currencies, crypto or central digital currency, they are very important for us as a central bankers. But I don't see there is a big role here in Qatar. But we are already set a very good, foundation. We have a good strategy about financial technology. We have also a lot of research. We are conducting so much research in the central digital currency. But as during COVID-19, we have also financial technologies activities. And there are payment activities, which is also very important. So in the payment, as it's hard for the central bankers, it's very important that we have to be careful about soundness and also the reliability of the payment system. So this is a very important area because we have seen some financial technology has been involved in this payment, and we have also seen some big tech involved in the payment. Therefore, this is a very good, important subject for central bank, that payment should not be, should be reliable, sound, very strong for settlement and also for clearing for our investors. So we are keen about this payment system, that it should be under a very good environment.
Sheikh Abdullah bin Saud Al Thani, Axel Weber, thank you very much for joining this panel. I'm Stephanie Flanders, Senior Executive Editor for Economics at Bloomberg, and this has been a panel on powering global finance. Thank you very much.
Hello and welcome. My name is Eric Schatzker. I am an editor-at-large here at Bloomberg in New York City, and this is the Global Outlook, our next panel at the Qatar Economic Forum. First, I'd like to introduce my distinguished panelists. Jenny Johnson is the CEO of Franklin Templeton. Manny Roman is the CEO of PIMCO. David Rubenstein is the co-founder and co-chairman of the Carlyle Group. Together, they oversee approximately $4 trillion in assets. Folks, I'm going to be asking at least one polling question over the course of the next half hour, so please pay attention and do, if you would, respond when you hear me introduce a poll. I don't see any reason we shouldn't begin with our questioning right now. Panelists, the COVID-19 recovery trade has been nothing short of breathtaking. And if you were bullish on reopening and positioned for reflation, it has been extremely profitable. Manny, you speak for $2.2 trillion at PIMCO. Are you bullish? Does the recovery trade have room to run, or has it played out, and why?
Well, thank you for the question. I think that you have some sectors which have been incredibly good to invest. I think in March 2020, you had real opportunity in high yield and in private credit. And for all of us, I think it's been very good. There were special situations to invest in. And I think people who put capital to work have been very happy. Now, if you look at the high yield index, a lot of it has played out. You may have another bite at the apple if there is some tapered tantrum down the road. And then there are sectors which I think will be incredibly exciting to keep on investing. Real estate being one of them. I think that real estate is one of the sectors which hasn't fully recovered. There's a lot of question mark and uncertainty about the role of officers, who's going to come back to work, how is it going to work? And I think the whole sector should provide for astute investors to be a real opportunity.
Manny, just a quick follow-up there. Given what you've just told me and told the audience, what's PIMCO doing? How do you position to take advantage of the opportunities, even if there aren't so many any longer, that still remain?
Well, in a mutual fund, and I think I have to be a little bit careful and distinguish a mutual fund from the private side of a business, which has long lockup structure. But on the mutual fund side, we've taken some profit. And I think we want to be flexible enough and have enough cash to capture opportunity. And so there were time to buy incredible assets in March and April 2020. They have rallied quite a bit. I think you have to be disciplined and make sure you have dry powder to be able to deploy it. And I don't need to tell you, as the last panel pointed out, that there's a lot of uncertainty about what's going to happen with inflation. We have a view, we may or may not be right, but I think we'd also try to invest around this. There's plenty of opportunity in emerging market. All of those questions, I think, leads you to take profit on some of the position that you took in March 2020 and make sure that you can redeploy your portfolio.
Jenny, you oversee an extraordinary range of strategies at Franklin Templeton. Are your strategists and portfolio managers telling you what we just heard from Manny? It's time to raise your cash allocation. It's time to take profit. It's time to wait for the next taper tantrum, perhaps before deciding to invest more aggressively?
Well, let me first say that unlike Manny, with the $1.5 trillion that I oversee at Franklin Templeton, we have 14 different independent investment teams that have very differing views. We have great debates internally about inflation, and we span the entire spectrum. And so I do not speak for them. They are completely independent. And I would say that, I think the reopening trade, what we do agree on is that you're going to see this in waves as the vaccines roll out. Obviously, developed markets like the U.S. and Europe are further ahead, probably hit 75%. And I think the U.S. is projected in 5 months and EU even sooner. But then there's other markets that are much longer, Russia, 12 months, India, 19 months, Indonesia, 23 months. And so I think we're going to see this stimulus, this reopening stimulus kind of in waves and carry through. I think that, we're bullish on things like, commodity currencies in areas where you're protected if there is more inflation. I think cyclicals, we still think that there's still run. Again, 14 different independent teams who have their own view. So, each one independently comes up with their conclusion there.
David, Carlyle invests with a much longer horizon. And so I wonder, from your point of view, have the best opportunities in the recovery trade already played out, or do you see them still ahead?
Well, it's too early to know for certain, but I don't think we feel, and I don't think people in the private equity industry feel that it's too late to pursue good transactions. It's been clear to us that the Federal Reserve is not going to increase interest rates this year, and almost certainly not for a number of months into next year. We'll have to wait and see exactly how long they wait before they actually increase interest rates. But as long as interest rates are reasonably attractive, as they certainly are now, and as long as the Congress of the United States doesn't do anything that's deleterious to the economy, and I don't see anything like that happening now, I think the private equity world is generally doing pretty well. Profits are being taken off the table when that's appropriate, but many good deals are still out there. Prices are not cheap, for sure, but people have gotten comfortable with somewhat lower rates of return than maybe 10 years ago because the alternatives are just a lot less attractive than anything else. So private equity continues to do well, and many investors are putting a lot of money into private equity because they like the longer term nature of the business, but they also think that the returns are likely to be better than anything else they can legally do with their money.
There are multiple forces reshaping the global investment landscape, from monetary policy, of course, to shifting geopolitics, to technological disruption. Jenny, I'd like to begin with you here. What do you consider the most important or dominant of these forces, and how are you responding to them?
I actually think that the underappreciated disruption force is really blockchain. And I think what's happened with things like cryptocurrencies like Bitcoin have been the greatest distraction to understanding really true disruption that I think is coming. And I think we're at the tip of the iceberg. So within finance, you hear, decentralized finance. I think that's going to be significant. And when I say, the distraction, I think that's non-sovereign backed. I think you're going to see sovereigns who express their currency in digital, and the reason is it's better from a cybersecurity standpoint, so counterfeiting, and I think it's better from a being able to track payments and therefore be able to tax on things. But with the technology, and when I talk about the business model, the ability to kind of pay your client for the value they bring, I think is a whole new model. So let me give you a couple examples. There's something called Tether TV. Tether TV is a streaming service that tries to be the fastest streaming service. When you're watching content, they're paying you T-Fuel coins and leveraging your device to cash it to others. So you suddenly become a client who has become also part of your infrastructure. Imagine in the case of a search engine like a Google, where today when you're searching, your profile is completely the asset and advantage to Google. Well, would you change to a new search engine if you were actually paid tokens for some percentage of the value of your profile? And I think that these business models are really early stage in understanding them. I think it's going to be very disruptive. And then I think for asset management, the ability to tokenize ownership is going to unlock illiquid assets, because the frictional cost of transacting, selling my ownership to somebody else is going to be dramatically reduced, which is going to democratize a lot of historically illiquid assets.
Jenny, at a corporate level, are you making a bet? Is Franklin Templeton making a bet on blockchain or tokenization?
So first of all, we announced that we are working on a tokenized money market fund. So right now it's in pilot. We're working with the SEC. We've built the what's called the kind of the books and records, the transfer agency on the Stellar network. We're right now piloting to ensure that is consistent with our traditional transfer agency system before we want to retire it. We make investments in blockchain companies, and we continue to look at the space. We have an incubator. So we had a company like Curve. You may have heard they were a crypto wallet. They were one of our first companies in our incubator. So we're focused on this space.
You've given me a perfect entree to our first polling question. This is an alert for the audience. Here comes the question. Do you desire some form of crypto exposure in your investment portfolio today? It's a simple yes or no question. Do you desire some form of crypto exposure in your portfolio? And as we wait for those answers to come in, I'll move on and ask this question. It's not just crypto. The newest generation of investors, young adults in their 20s and even kids in their teens have rallied around three powerful trends in the markets. Crypto, as I say, is one. Meme stocks is another. And SPACs are a third. And I'm very eager to have your perspective on this, David. Crypto, meme stocks, and SPACs, are they for real?
I think they are. In crypto's case, I would remind people it's not in the 10 Commandments that you have to have governments issue currency, and that can be the only currency that people use. So other currencies can be used. And remember, before governments actually issue currencies, they were issued by various banks or other kinds of institutions in a society. So I think crypto is here to stay. It's too late to change it. It can be better regulated, perhaps, than it is. Maybe there should be more disclosure. But I think people are looking for a different way to put some assets to work where they don't really feel that there's inflation that's going to be a big problem for them. So it will have its ups and downs for sure. And I think the greatest opportunities there may be in things that help transfer assets from one type of digital currency to another, or help trading, or other things relating to blockchain, not necessarily investing in a particular currency. I think what we're seeing is that before COVID, we had a digitization of the society, and it was moving forward. People were used to their smartphones and so forth. But during COVID, we got used to even more digitization, and I think it's too late to put that genie back in the bottle. So for the next 5 years, 10 years or so, you're going to see a massive change in the digitization of our society. And the things you just mentioned just reflect that, are the tip of the iceberg. I think we're going to be here for quite a while in terms of watching the society move towards more digitization. And gradually, the people who are the younger people who are making these changes and also forcing us who are older to look at them are the ones who often move economies. Economies are generally moved by younger people making purchases or coming up with new trends. That's true for a long period of time, but it's become even more true now as we see these kind of stocks and these kind of currencies and these kind of assets being pushed in large extent by younger people.
Manny, I know that PIMCO has and here we are with the results for the moment of our polling question on crypto. And as many of you can see, it's a dead heat. 50% of the audience wants some form of crypto exposure in the portfolio today. 50% doesn't. But can you imagine what these numbers might have looked like a year ago, 2 years ago, 3 years ago? I should just ask you, Manny, would you have anticipated a dead heat like that, 50% for crypto, even a year ago, 2 years ago?
No, certainly not. And I think one of the factors, to come back to the question you asked before, and to answer the same question than David, is that we had a recession with COVID like nothing we've seen before. And the instrument in terms of sending checks to the American people were blunt, but it also gave purchasing power to a lot of people who also stay at home. And I think you saw a flurry of trading activity in both meme stocks and in crypto that you can look at as a way to invest, or you can look at legalized gambling. And I think both views can be justified. But what is very clear is that a lot of these companies don't deserve the valuation that they get. Last time I checked, markets are more or less efficient. And the only way to explain the valuation of a stock is price earning. And you can discount future growth, and you can discount future market share and future profitability. And you can make a convincing argument why so many tech stocks trade at such high valuation. But at some point in time, you do need to make money one way or the other. You do need to have a business model which wins. And I think that some valuation and some of the volatility in all of these assets make absolutely no sense.
So you believe in the fundamentals still, and as a result, I don't want to put words in your mouth, but it sounds to me as though those meme stocks are a short.
Well, it takes a very brave person to short, because unlike long, if you short and you're wrong, your exposure goes up. I think you stay away. Stay away is the best thing.
And I know that PIMCO has a considerable SPAC business as part of your special situations unit. But tell me, how do you harness the enthusiasm and interest in the meme stocks, in platforms like Robinhood, in crypto, they aren't elemental to what PIMCO does, but perhaps there's a way that you can take advantage of them.
I think we try to stay focused. I think we run a very tight fixed income shop, and Dan Iverson and I think, have the view that we're as good as our returns. And we focus on investing in fixed income and in real estate and do the best possible job. And there's a lot of things we don't do. And there are other people, some of them on this panel, who do a really, really good job at other things. And we try to focus on what we know how to do. And you know, if you come back to the same thing again and again, our clients come to us for performance. And they come from us to be focused. And if Robinhood is a great, successful business, so be it. And it's wonderful for them, and we can both coexist very happily in the world.
Jenny and David, do you share Manny's view on meme stocks, that they're overvalued and perhaps, if not a reason to short, a reason to stay away?
Absolutely. I mean, I think that, you know, professional investors like predictability. They like to know that there's value in the company and that you're measuring that value. And the meme stocks are more of a social phenomenon that doesn't have, you know, specific value tied to it. Therefore, it's just, you know, it's unpredictable. And sadly, I think that, you know, you can end up with a lot of folks getting burned that don't really understand how much they're risking and how burned they can get.
And what about you, David? Are you buying into the secondary offerings by GameStop and AMC?
Well, let me just say that I don't think people should put all of their net worth into these kind of stocks because they are risky for sure. But remember, the art of investing is the art of predicting the future. And to some extent, nobody can really predict the future, but for some part of one's assets, you might take some speculative risk with the idea that if you lost that money, it's not the end of your existence. So some small amount can go in there. Remember, investing for some people is pleasure, it's fun. And it's not only to make money, they'd like to make money, but some people get a great deal of enjoyment out of playing the market, doing these kind of things. And if it's a small amount of their net worth, I don't see any great harm in it, assuming it doesn't overall affect the overall system of our economy. But generally, I'm not as worried about it. I am more worried about gravity. Eventually, the great economy we have is going to come down. Gravity always takes force and takes over. And so at some point, we have to recognize that not just for these kind of stocks and these kind of assets, but for all the economy, gravity will take hold. And I suspect it will be at some point when the Fed is clear it's going to increase interest rates, and everybody knows that's going to happen in the not too distant future. And if Congress ultimately decides they're going to have tax increases, that'll have an effect on the economy and produce some gravity effects as well. But remember, things can't go on forever going up and up and up. At some point, they'll go down. So I think people should be cautious. But my point here is, if you take 5% of your net worth or some small percentage, and you go into these kinds of assets with the understanding you could lose it all, and you enjoy doing it, and just the thrill of investing in these kind of things gives you some excitement, I don't think it's the end of the earth. I just wouldn't put too much of one's assets in that.
Speaking of the immutable laws of the universe, panelists, a question for you on climate change. Climate change is the existential challenge of our time, we might say, and some of your peers are taking an activist position in the climate change debate. I want to know what you think. Where, Jenny, do investors, asset managers belong in the fight against climate change?
Well, I think, you know, look, as you said, I mean, it is the big question, and you know, we're managing money for clients, and so, you know, if your clients want their money where it's invested in such a way that it's having a, you know, an impact, you know, lower carbon emitting companies and companies that are progressing towards this. I mean, you know, the spectrum goes, let me consider these factors all the way to, I want a, you know, specific green bond fund, say. So, you know, I think it's here to stay. I think that the data is not great as far as companies reporting on these things. It's getting better. You as asset owners and managers on behalf of clients, we have to respond to that. So I think it's a part of our investment process, and I think it's a part of every asset manager's investment process, because I don't think this issue goes away. I think it just continues to grow, and the awareness continues to grow.
David, what do you think? Should asset managers take a stand on climate change?
Well, I think they should do the best thing they can for their investors, and to do something good for your investors means taking this into account. Clearly, climate change is recognized around the world as a global force that's going to change the way we live and conduct our lives for forever. And if we don't do something about it, we're going to be harmed. Therefore, if you're going to be an investor, you have to take this into account. So good companies are going to be ones that take into account climate change. Bad companies are the ones that ignore it. So if you're investing in these so-called bad companies, you're not likely to do as well. So as the zeitgeist of the era is moving towards a recognition that climate change is here to stay, if you invest in companies that don't take it into account or are not sensitive to it, you're not likely to do that well. So I think not just because it's a socially responsible thing to do, but because you're likely to get better returns if you are sensitive to these issues, I think all kinds of investors should take these into account. We do in private equity, and I know in other areas people do as well. Private equity firms are now very sensitive to climate change and ESG-related concerns because they think it's not only good for society, but it's going to actually lead to better rates of return.
Manny, do you share that point of view? Do investments with sort of a climate change tilt offer or promise better returns?
Well, we don't promise anything, and I think we're incredibly careful about what the future looks like, because the reality is we don't know, especially in the fixed income world. So we are very, very careful about making any promises. That being said, every single bond we own has an ESG rating. We have a whole team dedicated to the effort. We're incredibly active in terms of making sure we understand the climate risk in our portfolio and in our various clients' portfolio. And then clients have very different utility function and very different constraint. And we try to manage money in the best possible way we can for different clients. I'll give you an example. Our parent company, Allianz, for whom we manage a lot of money, has made a commitment to be at net zero in 2040. And so obviously the portfolio will look quite differently than some other investors who made no commitment. And so you have different glide path and different asset constitution depending on your view in terms of where you want to be in 2030, in 2040, in 2050. But I think one needs to be flexible. I think one needs to be realistic about what the returns will look like, knowing that some assets, as David pointed out, may become stranded. There are sectors of the economy where a lot of investors will decide that this is not for them. You can think of coal, for example, where a lot of investors will say, you know what, we don't like the coal industry. We don't want to invest into coal. And those assets may become very cheap. And they may become cheap enough that they provide great investment opportunity. And, all of us will be confronted to these issues down the road.
Manny, I'm going to stay with you because you raised this point earlier in the conversation. Just 3 months ago, inflation seemed like the most pernicious threat to the global recovery. Today, however, the market seems to be accepting Fed Chairman Jay Powell's assurances that inflation is transitory and under control. What do you think?
Well, we coined the term head fake and said that inflation was a head fake. Now, what does it mean? It means that you're going to see a number of prints where you'll see inflation going up over the next few months. Why is that? Because the economy is coming back to work. We never gone through this before. It's going to be uncoordinated by nature. You see supply issue in both the labor market, where people are slowly going back to work, but when when they stay at home for a long time, you may have some inflation in wages for the time being. And then you will also see global trade being impacted and some inflation pressure, chips being one of them, being the obvious consequences. Now, this is, in our view, a transitory phenomenon. and that the deflationary forces which are at work in the economy long term will take over, and you'll see inflation gradually coming down. I think that the message from the Fed, which in our view was hardly surprising, is yes, we are a little surprised by how inflation has gone up, but we're here to act, and we're here to raise rates in case we need to. And the market has reacted in an extremely rational way. The curve has flattened, and the 10-year has gone from 162 to 148, and pricing inflation expectation the best the market can.
David, everyone I talk to in your industry, private equity, says that he or she sees inflation at every stage of the supply chain. Carlyle owns hundreds of companies, indirectly employs hundreds of thousands of people. What do you see?
Well, I work in the White House when we had 15% inflation in the Carter years, so I know what real inflation is, and this is not that type of inflation. We've had for the last 25 years, we've had 2% or so inflation. So when we go to 3% or maybe 4% for a brief period of time, it does seem a high compared to the 2% we've averaged. But the truth is, 3 or 4% inflation historically over, let's say, 50 years or so is not a terrible rate of inflation. So people, I think, have to get used to the fact that we're coming out of the COVID period of time, and people are spending more. People are anxious to do things they couldn't do for a while. So it's not unlikely that we'll have 3 or 4% inflation for a brief period of time. But I don't see anything going above 4% any sustained period of time. I think it's likely to settle back, as the Fed thinks, to probably a more normalized 2.5%. So I do think that prices are going up, and we do see it in our companies, but I don't think it's anything to be alarmed about at this point. And in fact, we see in some areas inflation is going down. Lumber, for example, was thought to be very high for a while. Now prices are coming down. I suspect you'll see that in other parts of the economy as well as people adjust. So I'm not that worried about that. There are bigger things to worry about in the economy, in my view, than inflation going into a much higher rate than we can really tolerate.
While we still have an opportunity, I'd like to ask my second polling question of the audience, and here it is. Which region represents the best future investment returns? There are 5 options: Europe, North America, Latin America, Africa, or Asia. Again, which of the following represents the best future investment returns? Europe, North America, Latin America, Africa, or Asia? I'll give the audience an opportunity to answer and put this first question here to you, Jenny. Where by asset class, strategy, or geography do you see the most attractive returns right now?
I think, again, this depends on kind of the reopening rollout and how quickly, folks can respond, or different countries are responding. And you're definitely seeing places like Latin America, in parts of emerging markets that are much slower and haven't gotten COVID really under control and haven't gotten the vaccine rollouts. And so they'll be more delayed. Again, I kind of mentioned, I think that the U.S. we're seeing, you try to book a flight, they are booked. You try to get a reservation in restaurants. People are getting out, and I think that in the short run plays better for the developed markets. And that's where I said, I think there's still room in the cyclicals, real estate, and then I think that again against a little bit of a hedge on inflation. Commodities and some of these commodity currencies, I think, are a good place to position yourself.
David and Manny, I have to come to you very quickly on this one. Where do you see the best returns by asset class, geography, or strategy at the moment? Manny.
I like the U.S. I would go long the U.S. I think there's going to be plenty to do. I think the U.S. is an incredibly deep pool of alpha being stored, and then I like Asia. And I think that people are going to make money in Asia for the next 10 years.
David, quickly, last word to you.
On a risk-reward basis, nothing is comparable in the world to the United States on a risk-reward basis. If you're looking for just high rates of return, probably China and other parts of Asia are probably going to have somewhat higher rates of return over some period of time. But on a risk-reward basis, taking into account rule of law and other kinds of things, nothing is comparable to the United States, not even close.
Well, I'd like to thank all of you. Jenny Johnson from Franklin Templeton, Manny Roman from PIMCO, David Rubenstein from the Carlyle Group, as we see the results of our latest poll. Ladies and gentlemen of the audience, thank you for joining us For the Global Outlook here at the Qatar Economic Forum, I'm Eric Schatzker. Goodbye.
Joining me now is Dr. Vera Songwe, the Undersecretary General of the United Nations and the Executive Secretary of the Economic Commission for Africa. Hi, Vera. It's so wonderful to see you. And I want to start by talking about a concept known as the Liquidity and Sustainability Facility that you have been the architect for. What exactly is it?
Listen, first of all, thank you very much, Zain, for having me today at the Qatar Economic Forum. It's a pleasure to be here. Talking about the Liquidity and Sustainability Facility is the most important thing we could be talking about here today, because it is about recovery. It's about how emerging markets, frontier economies get out of this crisis. It really means when frontier markets and emerging markets sovereigns go to the market to issue bonds, we have two components to those bonds. We have a debt premium component, which is about how you assess their macro stability, how you assess their country risk. And you have another one, which is called the liquidity premium, which is essentially about, once I buy that bond, can I retrade it? Can I make the bond liquid immediately, hence liquidity facility? And for most emerging and frontier market economies, you can make the bond liquid immediately, which means that bondholders have to hold this bond in a manner that is illiquid. What does it mean illiquidity? It means they can't convert it to cash and do something else with it. As we all know, if you're not using your resources that you have, then somebody must pay for that. So what is happening is emerging and frontier market economies are paying for this liquidity premium, which is the person who is holding their bond. The bondholders cannot make that bond liquid immediately, the next morning, the next minute. In the United States, this market for making bonds liquid, when you buy a US Treasury bill, within the hour, you can make it liquid by going to the repo market. The repo market in the United States is over a $20 trillion market. In Europe, it's about a $7 trillion market. We don't have this for frontier economies, and hence the increased cost of their debt. What we're looking to do is reduce the cost of frontier and emerging market debt so that they can use these resources themselves, the emerging markets, to do more growth, more development, and more important things. So that's really what the Liquidity and Sustainability Facility is.
And you've taken your concept to the IMF, to the ECB, to various central bank governors, to very many heads of state, personally talking to them about what you're trying to do and explaining exactly how it's going to work. Could you break it down for us in practical terms? How do you get this enforced?
In practical terms, what we need today are three things. The first one is, for the first time in 10 years, we have the issuance of what we call the special drawing rights, which is additional resources that are being put into the International Monetary Fund. What we are looking to do is use some of those to fund the launching of the Liquidity and Sustainability Facility. Remember, what we are trying to fix here is correct the market distortion. We're not asking for any special treatment for frontier and emerging market economies. We're actually trying to perfect the market. We're trying to do what we've always said we should keep doing. How do you make it work in practice? You have the funding. If we can get the funding from the SDRs, then essentially what you do is, when emerging and frontier market economies decide to issue bonds or raise debt, they come through this facility. Anybody who uses this facility then knows that they can immediately make their bond liquid the next morning. So they take away the cost of asking or charging the sovereigns for holding the bond for much longer. Now, the second thing we're doing, which is why we're calling it a sustainability facility, is also we're saying we can reduce the cost of the bond or give an additional premium if you're going to invest the resources in sustainability or green growth, renewable energy, better infrastructure. And so practically what you do is all we're looking for is create a funding mechanism that just allows us to reduce the cost of this liquidity by creating a repo market that allows bondholders to be able to repo their bonds, which is essentially resell them.
And where exactly are you in this whole process? What do you need to make this a reality?
We need the funding. That's, I think, in terms of what we've done over the last year is socialize the idea with many of the heads of state, central bank governors, ministers of finance, the World Bank, the IMF. And I think we now have a clear understanding by most that this is a market distortion that is making debt more expensive for emerging markets. Now what we need is somebody to fund the initial idea. We're looking, eventually we're looking for about $30 billion, but we could actually start the facility with about $5 billion. So what do we need today is funding, not an investment, but just funding. So it's collateral, initial collateral of about $5 billion to start the mechanism rolling.
Vera, if I could just pull out for a moment and just look at the big picture of the continent of Africa and the economic situation post-pandemic. When we look at going forward post-pandemic, what is it that you see? What does Africa need post-crisis? Because we're still in emergency and response mode.
And that's a very, very good question. I mean, the first thing Africa needs is some liquidity, hence the liquidity facility, some sustainability, which means looking at how you grow out of this crisis in a sustainable way, in a green way, creating more green jobs, creating more jobs that are responding to the needs of the African Continental Free Trade Area Agreement in particular. But what all that summarizes into two things. The first thing Africa needs to do is create more jobs. How do we create more jobs? Is diversify our economies. Diversification is going to be particularly important. We have seen the whole sort of digital economy, explode during this crisis. But the digital economy, when we talk about it, seems like something discrete. It's a long continuum of renewable energy batteries, of a better applications on your laptop, of medical technology, of biotechnology that's working well, of cybersecurity. I think we need our economies, particularly African economies that have been mostly commodity-driven economies, to begin to see how, one, we add more value, first of all, but secondly, how we diversify our economies. The economies that have done well during this crisis are economies that had access to liquidity, that had a green growth agenda, and finally, that we're doing something that was embracing the fourth industrial revolution, just diversify your economy and move towards better technology-enabled systems.
Dr. Vera Songwe, the Undersecretary General of the United Nations and Executive Secretary of the Economic Commission for Africa. Thank you so much for joining us, Vera.
Thank you, Zain. Thanks for having me.
Investing with purpose. That is our next panel. What a great array of panelists we have. Welcome, of course, to the Qatar Economic Forum, Henry Fernandez of MSCI Inc., the chief executive there, one of course, the key providers of indexes. Larry Fink, Blackrock, of course, the largest asset manager. Bill Winters, CEO of Standard Chartered, an emerging market-focused bank. It is wonderful to be here with all of you, gentlemen. And I feel like 2020 was clearly the year we understood what investing with purpose meant. We've all heard and understand what a social crisis has been, what it's meant, what a climate crisis is, and what it means. But we want to now push this conversation forward, guys. We want to understand not only what you've been thinking from the annual letter that you put out back in 2020, Larry, Henry, the thought leadership you've got in terms of the role of capital markets, Bill, the work you're doing with the voluntary carbon offset market. You're all playing your roles. But Henry, what more about measurement do we need to see? The SEC looking at proposing new roles on ESG disclosure. How do we know you're already making an impact in the capital markets?
Well, thank you for having us here, Caroline, and it's a pleasure to be in this panel with Larry and Bill. I guess measurement, not enough yet at this point. There is quite a lot that still needs to happen in terms of the the disclosure by companies about ESG in general, but also particularly climate change. We estimate that only about a third of the companies in the MSCI All Country World Index, which is about 9,000 companies and 98% market cap, 50 countries in the world, and only about a third of them, are reporting, for example, net zero pledges. We still have a long way to go, but we believe that there will be an acceleration of this, particularly this year, coming out of COP26 and all the focus of the U.S. administration and the rest of the world. And we better start doing it because with respect to climate change, there is a major reconstruction of the entire global economy away from fossil fuels into renewable energy that needs to happen in the next 10, 20 years. Some people think it's 30 years to 2050, and that's not going to be that long to achieve this. And there is a repricing of assets that is already happening, and is going to accelerate, and a reallocation of capital. So the measurement tools need to be there to be able to provide and facilitate that process of reallocation of assets and repricing of assets for investors and for companies to understand the trajectory they're on there in terms of net zero goals in their operations.
Larry, that fundamental reshaping of finance is one that you sort of spearheaded in that annual letter that you wrote, not of this year, but of 2020. But we now sort of feel as though everyone is smelling greenwashing everywhere. Everyone's worried about whether or not really, truly the ETF they're getting into has the right companies within it that are ticking the E, the S, the G that it seems to be providing. How do you hold yourself accountable to that?
Well, it doesn't matter whether I agree or disagree, but I think the capital markets are moving faster than most of society. We are seeing more demand for sustainable strategies. More investors worldwide believe climate risk is investment risk. More investors around the world are asking, how do we determine the path towards decarbonization and how each company is performing in that path? And I think from the ExxonMobil vote, we are seeing vast change very rapidly. The issue is not whether somebody thinks how the composition of an ETF or any portfolio is right or wrong. We could go into a long debate on that. But we are not going to get to a net zero world if we're just asking public companies to move forward. Public companies are moving more rapidly than most governments, moving more rapidly than most society. If we really want to get to a net zero world, it has to be all of society working together. We cannot focus on divestiture from public companies. That is not a good outcome, because we want to be transparent and see how companies are moving towards their entire transition and how they are performing in this transition. We need governments working with the private sector. We need investments to complete the decarbonization. You frame the question, and other questions are around maybe electricity and cars and all that. We're going to get there because we have moved the power grid to now being having zero green premium. But that took 30 years to get to wind and solar to be equivalent of coal. Obviously, we have issues related to the persistence of power because of wind and solar, so we need backups. But I don't hear enough about creating green cement and green agriculture and green hydrogen and steel. We're focusing on one segment of the economy, and we need to be focused on everything. But just getting to your question related to the composition of a portfolio. More and more sustainable strategies still have to be tethered towards a liability, the MSCI index or a S&P or any other liability. And what MSCI and what Blackrock has been creating are composition portfolios that are democratizing what people want. It doesn't mean it's 100% in a decarbonized portfolio, but what it means is we are picking the company in each industry that is moving faster in a decarbonized path. So it may mean we own a hydrocarbon company or a company that's making hydrogen, but our scores are better. Now, some people may call that greenwashing because we may own a hydrocarbon company. This is not a black and white world. We have to evolve and move, and we are working with pension funds. And in the United States, we have to make sure that we quantify that investment risk, that climate risk is investment risk. We can't do it because we believe in climate change alone. We're not permitted under the law of the United States to doing that. So we have to have quantifiable data. And this is why with what MSCI is doing, what Blackrock is doing with Aladdin Climate, We are developing the analytics and data so we can justify these investments. And through that justification and through more disclosure, because when the SEC asked for more TCFD disclosure, as Europe asked for more TCFD disclosure, we're going to have ability to analyze and design portfolios that democratizing more investment. So I'm absolutely convinced the tectonic shift towards investing in sustainability, it's happening. But that does not change the world. It changes the world only partially. And we need to be more focused on how we move the entire society forward, not just public companies.
Interesting. So you want public help, government help within the public companies and also private companies. But Bill, I mean, you sit here as, well, I think I just checked who your key shareholders are, and Blackrock is, of course, one of them when it comes to Standard Chartered. You've aimed to be the most sustainable bank out there. But how do you hold your measurements to account? You're looking at, Larry was just mentioning how it has to be more steel, more supply chain focus. How do you look at your supply chain as a whole to make sure that your bank is the most sustainable?
This is a huge challenge, and the way that it works, what we said is that, like many companies, as Henry mentioned, we've committed to transitioning to net zero by 2050, and getting there much sooner in terms of our own operations. But over 95% of our emissions are emissions that we're taking responsibility for on behalf of our clients. So it's the steel manufacturers and the airlines and the shipping companies, fossil fuel producers around the world. And there is no agreed taxonomy for the allocation of those emissions responsibilities today. Being able to state clearly what is our baseline, so we're going to go to zero from what, is a matter of quite a bit of work that we're doing right now. We've committed to do that work between now and October or November, something like that. We'll publish our results. It won't be perfect because the data that we have access to from many of our clients, keeping in mind the Standard Chartered Bank is a bank that disproportionately serves developing countries in Asia, Africa, and the Middle East. And the quality of the data in those markets, in many cases, is nowhere near as robust as what we would have in Europe or the US, or for that matter, China or Japan. And so we're going to have to use proxies. We're going to have to use some approximations, but we'll publish it. And then we'll commit to get that down to net zero, largely through working with our clients to affect their own transitions. Most of our clients we've already engaged, and they are very actively working on their net zero transition plans. We've done some really interesting research that makes it clear that for multinational corporations, roughly 75% on average of any MNC's emissions are coming from their own supply chain. So in much the same way as our emissions are coming from our clients to whom we provide financing, for the MNCs is coming from their supply chain. 80% of those suppliers are in countries that have less robust data frameworks than what we have in the US or Europe. So there's a huge underlying challenge. There's also an enormous financing gap. So these companies, in particular in less developed countries, only have access to about 10% of the transition financing that they're going to need. 90% has to be found. Of course, there's an opportunity there for a bank like Standard Chartered to help out. There's also a big gap that society will face. And it's clearly a gap that governments, the private sector, the public sector, multilaterals, export credit agencies, we're all going to have to work together to close that financing gap. And that's our undertaking. That is our approach. And we're full speed ahead on that.
Both you, Bill, and Larry have talked about government's role within this. And Henry, you put out, a very forceful viewpoint on the role of capital markets within the net zero revolution. It's interesting. Some are sort of saying that maybe the capital markets role, the investment opportunity within ESG is in some way almost a placebo effect. It's stopping the government change that is necessary. Do you agree with that in any way?
No, not at all. I think I concur completely with Larry's view, which is all of society, households, municipalities, educational institutions, private companies, public companies. All of society has to contribute to this net zero world that we need to achieve. Just as an example, publicly traded companies, as represented in the MSCI All Country World Index, the 9,000 companies that I mentioned, represent 22% of the total emissions, carbon emissions currently. That's about 11.2 billion metric tons of CO2 equivalent, and that's compared to the 50 plus billions of metric tons that the world emits. So that tells you that there is another 78% that needs to be addressed. So all of society has to go. And the role of government, I think government have begun to get together and push this, but I think the capital markets are beginning to move faster. One thing that is beginning to dawn on us at MSCI is that this reallocation and repricing of assets is going to be front-loaded. It's going to happen, it's already happening, and it will accelerate in the next few years. A lot of people think that this repricing and reallocation of assets is going to be back-ended towards the end of 10 years or 15 or 20 or 30 years. It's going to happen faster than most people think. So if anybody is running a company today, if anybody is running a portfolio today, they have to move fast, because otherwise this is going to have a significant effect in their portfolios. And if we begin to eliminate or disengage from the companies that are carbonized in the world, the universe of investment opportunity is going to be very limited. And the portfolios are going to be highly concentrated. And that's not going to be good for the capital markets either. So therefore, we all have to work together. There have to be a significant amount of engagement with companies to push them and encourage them and persuade them to decarbonize world, both private and public. I think all of us have to encourage our own governments to go on this trajectory. All of us individually in our own homes, in our own households, need to install solar panels and things like that. It have to be a major effort. This is a Herculean task that has not happened in the history of the world, particularly in a very short period of time. And there is no alternative. There is no planet B that we can go to at this point.
Well, you can just beat that with Elon Musk, maybe. But meanwhile, I'm interested, Larry, in the pushing, the persuading. You referenced it earlier, ExxonMobil. That was a dramatic change. A small hedge fund, Engine One, able to change up the board of Exxon, but not without your support. I'm interested in why perhaps you didn't lead the charge, why it took an Engine One to do that.
We're a fiduciary. Asset managers are at the nexus between the asset owners. It's not our money, and the companies we manage. We've had great dialogue, continuous dialogue with companies such as Exxon. In the past, we voted against different propositions within Exxon. We're thrilled about how this is moving forward. This is the tectonic shift that's happening. It doesn't have to be large companies. It's a movement. It's not one company. It's not Blackrock. It's a movement. And so I don't look at this as anything unusual or disproportionate. I love the system that everybody has a vote. And it doesn't matter if you're large or small. If you have a persuasive argument as an activist, and this is what this company did, and they provided a great slate of potential board members. And so our corporate stewardship team had the ability to make a judgment whether the current board or the composition of the board would be improved with this slate of board members. And the results are the results. But let's be clear, you're focusing on one company. There are thousands of companies that we are engaged with every year. There are thousands of votes every year. I think this year there was 250 climate-related proxy votes out of thousands, 10,000-ish public companies. The focus should not be on one or two companies. Now, obviously, that was a highlighted company. But our approach, having the largest corporate stewardship team in the world, is to be engaged with companies. We don't want to go to a corporate vote. We want to have companies moving forward through engagement, that we can agree with management and a board. And I would tell you, we made substantial changes with so many companies that we voted with, not against. And it's because they have been moving forward. They have taken an active participation in focusing on how they're moving forward in a decarbonization process or a net zero company. So whether it is on sustainability or governance or social issues, we are engaged. And I'm very proud of the position that we have taken whether it is our engagement with MSCI as a company or our engagement with Standard Chartered as a company. Our team is engaged all the time. We have meetings with companies continuously. It's not about having a binary decision of yes or no during a proxy. And unfortunately, media focuses on that binary moment of 250 proxies where there is this binary decision on sustainability. If we want to get to a net zero, it's about the other, 9,750 companies. It's about engaging with them throughout and moving them. And that's, of course, how we're going to change things, not one vote. I know it's nice and big, and we can talk about it on the media, but it's the things that are not being watched or seen. It is the engagement that we're doing persistently throughout the year. And that's our commitment to our asset owners, that we are going to be engaged with their money on trying to moving companies forward.
What about engaging with governments, Larry? What about when you're looking at China in particular, and there's this automatic friction that we think of when we think of China when it comes to the S and the G, the human rights element, but you sort of really clearly feel that it's better to have a seat at the table than not at all. How are you guiding when you're looking at making more inroads into China with Blackrock?
We're very engaged in China. We're the only international firm that have both licenses. We have written corporate stewardship positions on human rights. We are focusing on judging companies. We don't judge governments. We try to be non-political in the United States and in every other country, but we believe in engagement. We believe in connectivity. We believe as more countries, as more of economic activity is part of the global capital markets, in our opinion, and I'm sure in Bloomberg's opinion, because you participate this as a company, the more we have more involvement in global capital markets, the better we have engagement and better outcomes occur. So we're a big believer in engagement. We want more and more companies and countries to be engaged in the global capital markets. The capital markets are the ultimate judge, and so we believe we're playing a very big role. Our role in China is not about the political side. China has a very big need in retirement. No different in America. They have a great need in retirement. And we believe we'll have a role in helping Chinese build sufficient savings in retirement so they could live in dignity during retirement. And so our ability to try to build societies, it's consistent. When I talk about stakeholder capitalism, I talk about being a part of each society where you operate. And I could assure you at Blackrock and how we judge Chinese companies who are public, we judge them on their human rights activities no different than I judge European companies or American companies. And so we believe as more Chinese companies are engaged and more Chinese companies go public, whether it's on the Hong Kong exchange or the Shanghai exchange or the New York or London, we are going to be engaged with them with the same judgments on E, S, and G. And we believe that's a powerful role that we can play way beyond the politic of the world.
And a role that, Bill, you know well, as one of the oldest foreign banks within China, aiming for sustainability, your role within the emerging markets in general, like how are you finding these conversations are going? How little is understood in terms of the transition that they're making? You were talking about it a little bit earlier.
I think both Henry and Larry have referred to the pace at which I would say the sentiment and the reality are moving. And the fact is it's moving very, very fast. The number of places for any government or corporation to hide when it comes to affecting their own net zero transition, that space is shrinking very quickly. So companies or countries that thought that they could escape this by just putting their head down and letting somebody else take it first, they're finding that their access to finance, their access to capital markets, their access to customers for these smaller companies that are feeding into global supply chains, they're drying up, and they're drying up quickly. So in the research that we've done, 85% of MNCs intend to differentiate between their suppliers in developing countries who have a clear, credible path to sustainability versus those that don't. 15% have already exited suppliers that they recognize aren't making the efforts that are necessary in their opinions. That's only going to accelerate. So when we have discussions now in the least developed countries, but also in very developed countries, but that are outside of the US or Europe, is a very high level of engagement. I mean, China is launching its own carbon market. It has carbon exchanges at a provincial level today, rolling those up into a nationwide exchange that I think, if done successfully, and I know that's their intention, will rival the efficiency of the European market, which is, for the time being, best in class. And they're very keen to hear from the task force work, this task force on scaling voluntary carbon markets, how the government-backed compliance markets can interact with a voluntary carbon market, where we're trying to set very high standards as well. So I think there's a relatively recent but very substantial focus on the sustainability question in even the least developed of countries today.
That voluntary carbon offset market that you're digging into, Bill, how soon do you think it's reality in the US?
So it exists today. I mean, there is a voluntary carbon market today, but it's very fragmented, and it's I would say it's an uneven credibility. So you made a reference in an earlier question to Larry about greenwashing. There was a sense that the carbon offset market was used for greenwashing. Our objective is to set a single standard that effectively is a global standard. That's a very, very high standard, where no one will question the credibility of the underlying contracts if they're complying with these principles that we set up. And we're recommending the creation of a governance body that would also be global in nature, that would maintain these principles, because they will change over time as science changes and as understandings change. So to curate these principles and continue to fine-tune the market. It's not a matter of this being US or European or Chinese. This is for the world. We've got 400 members of this task force, 250 corporations. Both MSCI and Blackrock have been very substantial contributors to that effort, along with a broad range of investors, of emitters, of banks, NGOs, academics. And the one thing we all have in common is a view that if we have a really good, robust voluntary market, one will have better transparency about what the price of carbon is, which we can all use in our capital allocation decisions. Two is we'll have a facility to channel eventually hundreds of billions of dollars from the pockets of people like the Standard Chartered Bank or individual consumers into the hands of people that can actually get carbon out of the environment. That's the prize. We've got a consultation paper that actually closed. We took our last comments yesterday. We'll produce on July 8th, and I think the market will be up and running from then.
We'll look out for it on July 8th. Henry, I was just doing a quick last-minute search on Bloomberg News about the latest things you guys have been saying and thinking about and innovating. And oh, well, look, what caught my attention as a member of the media was, of course, the fact that potentially you're looking at crypto indices. But I'm interested in how you have to think so well-roundedly about ESG and every new innovation that you have, because at the moment, everyone's talking about, or perhaps Bitcoin mining not being good for the environment. How do you think about it in the decision-making and the innovations that you make upon the platform?
Yeah, so that's a classic example that everything we look at MSCI, we try to put a climate change filter on it. Climate change is really permeating every aspect of what we do at MSCI, from the recommendation of policy benchmarks to asset owners, to the creation of indices for investment products. We're putting climate change in our risk models for portfolio risk as part of some of the other factors that affect return and risk in portfolios. And cryptocurrency is not different. We're looking at 2 or 3 different ways to look at cryptocurrency. Clearly, a cryptocurrency index itself, but secondly, the climate change implications of cryptocurrencies and what does that mean for society and reducing emissions. We're also looking at cryptocurrencies in the context of the blockchain, particularly the effect that will have on industries and companies in various sectors. So it's pretty wide-ranging. One thing that I will add, going back to the question of emerging markets and China, in many of the emerging markets, we have had a number of sessions, especially in China, with the Securities Commission and with many corporate companies or corporate sector organizations and associations, describing kind of step by step all the elements associated with the E and the S and the G, and why many companies in their countries need to embrace this new world of an integrated world, taking into account institutional governance and protection of the environment and obviously encouragement of their very different, human capital and social issues. So the Securities Commission in all these places, especially in China, has been pushing us pretty hard to publicize a lot of this, to make sure that we are open and transparent, and that's going to help the capital markets of the country. So I will concur wholeheartedly with Bill in what he's saying about the movement there, and what Larry was saying about China and their role in climate change and in ESG. It's happening. Now it's happening, from behind, but it is happening.
Larry, is it something you're thinking about when you're looking at companies putting their balance sheet to work in Bitcoin about the ESG impact?
I don't see any companies putting their capital into Bitcoin, so I don't know I don't know the form of the question. I don't know of any companies that are putting their balance sheet in cryptocurrency. I can tell you, long-term investors are very unfocused on the tick-tock of the market, the tick-tock of the ups and downs of crypto. I think it's fascinating to watch crypto because it's inspiring a lot of young investors. I think that's fantastic. I think if that inspiration leads to long-term investing, that is a great outcome. But with our focus on long-term investing, and with 2/3 of the assets we manage are for pension funds, the conversation about crypto is a minor percent of any dialogue we have with any company worldwide. It's just not terribly important. Could crypto become a really important asset class one day? Sure. But right now, the bid-ask spread, the volatility, it has not led to widespread conversations worldwide. Where conversations I have with governments and leaders is about, should there be a digital currency, true digital governmental currency? That will change finance in a very substantial way. If there was a digital dollar, a true digital yuan, that will change however, that would be much more impactful than any other, like a crypto. But it's something that we look at, some of our investors use as one tool for investing. But it is really about the tick-tock of the market, and that's what public media does. You focus on the moment, the markets, and the ups and downs. BlackRock is focused on the long-term, building long-term portfolios as a fiduciary for our clients. And if we deem crypto or any asset in the world is a great long-term asset on behalf of pensioners worldwide or people building pension funds, then it'll be one of the tools for asset composition. But the tick-tock of the market, the ups and downs of what's going on in any one individual stock or a crypto, it's really unimportant.
And what is important, of course, is the focus that you guys are currently giving when it comes to purpose, investing with purpose, and indeed, whether that be about the E, the S, the G. We very much focused on the environmental. You've helped guide us through the societal and the governance. We really want to thank all of you for digging into the relationships that you're building, not only in terms of individual companies, but governments as well, and indeed the way in which you are looking at the capital markets speeding through what might be a key change that we're seeing at the moment. I want to thank each and every one of you, Henry Fernandez, MSCI, Larry Fink of Blackrock, Bill Winters of Standard Chartered. We thank you for your time at the Qatar Economic Forum.
Hi, everyone. I'm Francine from Bloomberg TV, and I'm delighted to welcome Jess Staley, Chief Executive of Barclays. And in this conversation, of course, Jess will talk about the markets, the recovery, and of course, how potentially the world of finance is now fueling innovation, sustainable, and an entrepreneur-led global recovery. So thank you so much for joining us today. Jess, the economy has been suspended for the best part of the last 14 months. What does that mean for the recovery we'll see?
I think it's quite extraordinary how the combination of the government, regulators, private sector businesses have really rallied to face this pandemic. And all the spend data that we see, all of the financial stability from consumers in the UK and US and around the world to small businesses to corporate is really quite something, given the size and scale of this pandemic. So, I've said a while before, I think this will be the biggest GDP growth year in the UK since 1948. We're seeing signs of that now. And so I'm actually quite encouraged as we go to the second half of this year that economic growth is going to be robust, and we're going to come out of this pandemic. And I think the success, particularly here in the UK, around the vaccination rate has just been a real testament to the government putting its shoulders behind addressing this pandemic.
Jess, do you worry that because of the variants, we could be in and out of lockdown for months to come?
So Barclays is sort of a unique place because, with a lockdown, we sort of think that everyone's working from home. We've had close to 20,000 people between the UK and India and elsewhere working. All of our branches are open. All of our call centers have been fully staffed. Our trading desks have about 60 to 70% occupancy. So we have a lot of people coming into work around the world. As I said, I think with the vaccination rate as high as it is now, and the measures that people have taken, while clearly COVID-19, looks like there's going to be another wave. But hopefully that doesn't translate into hospitalizations or more serious illness. And so I think COVID's around for a while, it looks like. But I also think our ability medically to deal with it is growing at pace.
Jess, a number of banks have warned of a bigger trading revenue drop than expected because of the lack of volatility, of course, that we saw in 2020 because of the pandemic. What does that mean for Barclays?
We had a record first quarter. The strategy of balancing a wholesale bank or an investment bank with a consumer business anchored primarily in the UK and the US, I think paid off last year. I think it paid off quite strongly in the first quarter. There's been a softening of market volatility, but publicly available information in terms of our business, whether it's advisory or equity capital markets, has been quite robust recently. So we continue to be encouraged about the balance, the balance of our business model. And as we come out of this recovery, and companies are doing better and small businesses are doing better, I think the concern around impairment will come down quite a bit. We have a very large impairment reserve. We were very conservative last year in terms of taking impairment charges. And given what we see right now with the economy, that gives us a lot of cushion.
What do you think the biggest, legacy of the pandemic is on the banks? Is it that there's some sort of redemption after the 2008 crisis because now banks could be a force for good? Or is it the fact that more people will be working from home because actually it's shown that big banks can be flexible with their staff?
So one, I do think it's extraordinary how the banking industry has performed during this pandemic, and that we could enable 50,000 people to work from their kitchen tables is a real testament to our teams in technology and operations. But to your point, I think 12 years ago the banks were seen as a catalyst to an enormous economic crisis, which millions and millions suffered from. And so hopefully it is for the banking industry, or for us, it's encouraging. I do think, as you sort of suggest, that we will be an agent to enable the recovery this time around. The level of engagement with the Bank of England, with the PRA, with the FCA, with Her Majesty's Treasury, with the Fed, is just, it's at a whole nother level from where it was in the last crisis. And given that we have the financial resiliency that we have, we closed the end of last year at the highest capital level in the history of Barclays. That allows us to stand by our consumers and our clients in a way that, hopefully we are deemed as someone who's helping the economy and business and consumers get through the pandemic.
Have you had any conversations with the Bank of England about possible resumption of dividends or, share buybacks?
So we announced earlier this year a return to paying a dividend. We executed a £700 million stock buyback program, so we've already started that. And clearly, we recognize that one of our obligations is to return excess capital to our shareholders, and we fully intend to do that.
Just going back to working from home, how do you see that developing? Are what does it mean for your real estate? Do you see bankers actually hot desking? Like, how much of a difference has it made to how you view your staff and where you want them to be?
So today I'm sitting in the office and we have an executive committee meeting right after my call with you. And pretty much everyone's going to be in and sitting around a table, which I think is a very important dynamic. So one of the things that's interesting, we went back and looked at what were our employees actually doing pre-pandemic. And I think businesses were already moving down the pathway to having flexible work hours. It's very important that we let a single parent leave on a Tuesday afternoon at 2 o'clock to take a son or daughter to a doctor or to a sporting event. That flexible working, I think, was already building up prior to the pandemic, and obviously the pandemic has accelerated a lot. So I think people will be flexible. I would be surprised if most people are in more than 4 days a week. But one of the challenges of the technology era is you can look at your iPhone at 10:30 at night and start texting away. So I think technology has actually increased the working hours, although maybe less so in the office.
Again, how does it change? So first of all, is it harder, is your biggest challenge now to either retain talent or actually hire talent? How, hot is the market for traders right now? And do they want that flexibility, or is it about pay?
No, we're back into one of those phases of the war for talent. So we've done a lot of recruiting. I think quite well for Barclays. I think the financial position of the bank, what we're doing in terms of gaining market share now, 4 years in a row. I think morale is very high. We had 3 priorities going into this crisis. One, preserve profitability. So we've been profitable every quarter since the pandemic hit. And as I said, have done lots to build up our capital base. Secondly, was doing the right thing for consumers. So we waived last year over 100 million pounds of overdraft interest for vulnerable customers and small businesses. We created a 100 million pound charity that we distributed last year to try to help people deal with COVID-19. And then thirdly was to protect our employees. And we essentially secured the employment for 85,000 people around the world. And even just today, as we speak, in India, we've extended our financial safety net so that we are, we've actually set up an entire group to help parents and and relatives of our employees to get them into hospitals in India. So I think we're giving a commitment to our employees, a commitment to our customers, and we're preserving the financial integrity of the bank.
Could you do more on costs?
You know, we want to invest. One of the things, Francine, that we want to pivot, and we're trying to do this actually. You know, 2020 was the first year where we had no restructuring costs. And we're not going to have any restructuring costs this year. What we want to do is to go back into the normal, you know, run a going concern business, which is to watch your profitability, but, you know, use the investable assets that you've got in order to grow the business. And so we are keenly focused on growing our revenue as a driver to improvements in profitability.
Would you ever just consider actually selling some of your real estate, like office buildings, because of the way we work post-pandemic?
I think there will be, you know, a rationalization of our real estate footprint. But I would say it's more normal course. So no, we don't have plans to close full offices and tell people to work from home. No. We want people to come into the office.
What's your take on the City of London 6 months after Brexit?
I think the City of London has done a remarkable job. I think all of the, you know, I think the banks have, again, been very constructive. I think it has increased the dialogue with government in a very positive way. And I, you know, go back, you know, you can walk on a trading floor of the investment bank, but what I find the most energizing is to go to the local branch where I live in London and to see the dedication of the people behind the counters and engaging with walk-in customers day in and day out. And they've been magnificent. And, you know, banks have not closed. They stayed open. And they've done their service to the communities where we live. And so I'm pretty encouraged by where London is, and London will be fine.
How tough has it been actually for, you know, small businesses, for entrepreneurs? Do you see, is it trends basically that have just been accelerated because of the pandemic, or because of the pandemic we'll see businesses actually fail that shouldn't have had we not had COVID-19?
I think it's been fascinating, Francine, to watch that. Normally, as you go into a recession, the average consumer or small business will, you know, borrow a little bit more money, will use a little bit of their cash to try to maintain a lifestyle or to keep investing in their business. This time around, the reaction to the pandemic was fear. And what small businesses and consumers did is they watched their balance sheet as opposed to their income statement. So if you look at Barclays, for instance, borrowing, particularly on unsecured consumer loans, i.e. Credit cards, went down significantly. Deposits went up dramatically. So everyone focused on their balance sheet and giving themselves the financial resiliency to deal with the pandemic. That, on top of the support of the government, had a big influence. But also, we should not make the global capital markets. What they've done is extraordinary. The amount of debt and equity that we've raised globally in the capital markets for small businesses, mid corporates, and large corporate has just been quite something. So I think it's remarkable. I don't think any of us would have predicted how healthy businesses would be at this point in the game, and that speaks well for the latter half of this year.
Jess Staley, thank you so much for talking to us today.
Thanks, Francine.
Shruti Vadera, good to speak to you. Thank you very much for coming to talk to us. There's a lot of concern as we recover from the pandemic that we are in danger of exacerbating pre-existing inequalities. Give us your thoughts on inequalities that might have been increased by the global pandemic.
COVID has cracked wide open and deepened the fissures and the inequities that already existed before the pandemic. 250 million jobs lost last year. Global labor income declined by 8%. 120 million people fell back into poverty. And it disproportionately impacted the poor, Black and ethnic minority communities, women, young and unskilled workers. Advanced economies provided direct and indirect fiscal support equivalent to 28% of their GDP. Emerging and developing economies only spent 7% and 2%, respectively. Loss in GDP per capita, known as scarring, over a 4-year period in emerging markets is expected to be over twice that in advanced economies. Of course, many of these inequities and trends within countries existed pre-pandemic. It was fueled by technology transformation, which labor markets had not yet adjusted to. This had sort of disrupted 70 years of great moderation in which there was a stable division of income between labor and capital. But we had increasing concentration and growth and capital accumulation in certain sectors, companies, individuals, and where ordinary people turning up to work to exchange their labor, their skills, their time for wages was no longer allowing them to participate fairly in wealth creation and the great advances of society. And COVID has put these trends on steroid. For decades, we believed in globalization's gains, but ignored its pains, which were very local, direct, very acute. And we thought we could go back to how things were after the great financial crisis, even though in many countries it led to a decade of wage stagnation. And then we were surprised by the backlash which followed, including the rise of nationalism and populism. And as a result, political and geopolitical risk is now high on the risk registers of most companies in a way that it never was a decade ago.
And of course, we've seen very different pandemic responses from different countries. And I wonder if that is in danger of leading to very divergent outcomes.
Yes, of course. I generalize hugely, but to make the point, we could say that many emerging markets, especially in Asia, proved better at containment last year than advanced economies. But now the advanced economies are overall vaccinating more quickly. They're starting to remove restrictions, seeing surging demand, growth, recovery faster than emerging markets, possibly except China, of course. But there is this differential pace of economic rebound is very difficult in an interconnected world. It slows down recovery, especially for open economies who have supply chain and demand dependencies. And to the extent that the rebound leads to the exit of support measures in advanced economies and possibly interest rate increases, especially in US dollars, before emerging markets are ready to come out of the containment to start their rebound, it will exacerbate their economic woes. So sequencing is the key. The multiplier effect of everyone recovering simultaneously is huge, and the unevenness of the recovery will hold us all back. And of course, in addition to the issue of differential recovery, I would like to say that we seem to be living in a world where in the public discourse, it's as if the recovery will be costless. But debt with the economic vaccine, debt was like an economic vaccine. Global sovereign debt is 120% of GDP, just short of the levels of the Second World War, in fact. And that's a big bet on sustaining high levels of real growth over the next decade.
Okay, and so we would need to see a coordinated response, it sounds like, to tackle this. Are we seeing enough coordination in the response?
Well, the clue is in the name. It's a pandemic, not an endemic. And the idea that it can be dealt with only with national strategies for vaccination and containment is sort of farcical. As we found in the financial crisis, if by virtue of its ability to spread contagion, financial, economic, or health, if by its ability to spread contagion, a phenomenon is global, then coordinated and cooperative responses will obviously be the most effective way in saving lives and livelihoods. And a health contagion recognizes borders even less than finance. The G7 pledge last week is welcome, but it's not adequate for the scale and the urgency of the real threat that variants will continue to be created, including those that might evade vaccines, and can infect each of us until most of us across the world has been vaccinated. This isn't altruism, it's just self-protection. The G7 have purchased over a third of the world's vaccine supply, but make up only 13% of the population. There's a very straightforward plan written by the IMF and the World Bank, supported by the WHO and the WTO. These are our institutions of international cooperation. This plan has a cost benefit of 1 to 180. That is arguably the best investment you can ever make.
Shriti, thank you very much. Thanks for your time. Shriti Vadera from Prudential.
And I'd like to welcome now Citi Capital Chairman and CEO Yuchen Zhang. Thank you very much for your time today.
Well, thank you, Sherry, for having me on.
So we have seen this recovery take hold in Asia, but we're also seeing intermittent outbreaks of infections. What's the investment outlook across the region for you?
Asia is bouncing back nicely, particularly East Asia. We see a lot of opportunities as China emerged from the pandemic first. Many sectors such as healthcare, technology, and consumption are the major focus for most of the private equity investors and for us as well.
And yet we are seeing some signs of weakness across China as well, such as the clampdown on certain sectors of the economy, perhaps some liquidity tightening as well. How does this impact your investment outlook when you're trying to decide where you can find opportunities?
Well, for private equity investors, too much liquidity may not actually be a good thing. The fact that the Chinese government is taking proactive initiatives in curtailing the flood of liquidity that's around the world and as a sort of a preemptive measure, I think actually bodes well for the long-term potential of the Chinese economy. As for the crackdown on some of the anti-competitive practices, which were, fairly, rampant. It's time to curtailing some of the, the anti-competitive, monopolistic type of, behavior. And I think all of that in a year when you already see, the Chinese economy growing 18.3% in the first quarter. It's actually a good thing that because the Chinese government doesn't want the economy to overheat. So this is maybe the time to actually, take care of some longer term issues by, doing the clampdown.
But it's not just the tech sector where we're seeing the clampdown, right? We have seen it in other sectors as well. Private education has been one of them. And this has been one of those places where foreign investors have really looked at and have found opportunities. What's your take on that?
Well, the private, Chinese love education and they devote so much of the family resources to education. Education is a way of social mobility and is a system that the Chinese people believe in for 2,000 years, and so this is almost sort of like a religion. So when you have a college entrance examination system that's predicated on one exam once a year, and so people naturally will try to go to cram schools and try to get ahead of the others and having some sort of a head start. But unfortunately, this is an arms race, and everybody is doing that. I think at some point the government needs to crack down and roll it back a little bit, and that's what's happening. Because when you have some of the leading online education companies actually becoming the top advertisers on CCTV, it's the equivalent of being the top advertiser doing Super Bowl in the US. You have an issue. That means there's probably too much of that is going on.
But I guess the concern is, will big funds that have raised tons of money in the last couple of years, will they get burnt badly?
Well, I'm sure some of them are burned already. I think, but it doesn't. I mean, a lot of them, for example, we didn't go into it. Some of it, I think it may be just common sense. Too much of a good thing may not be good. So, when these online education companies spending money like crazy, and believing there's always money behind them, I don't think it's sustainable.
So tell us about your investment focus, because you've been sharpening your focus on certain sectors in order to differentiate yourself. Give us an update of that strategy.
Well, I've always focused on consumption. As you know, we control McDonald's China, which is doing extremely well. We have also focused on healthcare, which is a major growth area in China. There's a lot of demand as people getting wealthier and want to live longer. And then last but not least, in the technology sector, as the tension between US and China build up and looking and likely to recede anytime soon, there is clearly a technological decoupling which benefits the tech sector in China. So that's, by and large, that's what we're focusing on.
Do you believe that this technological decoupling will not result in the isolation of some of these Chinese firms? In fact, that, as you're saying, will actually lead to more growth?
Well, I mean, China is a huge market. It's probably in a couple of years' time, it will be the largest market in the world, and so there's plenty of room to grow for tech companies. So at the same time, China is not shutting itself off. In fact, it's opening up more. For example, in financial sector, service sector, and all that. So there's plenty of communication exchange with outside, which will benefit, the tech sector, in China and in the world as well.
Yiqian Zhang, Chairman and CEO of Citi Capital, thank you very much for joining us today.
Thank you.
He's a champion of socio-economic transformation and financial inclusion. He's envisioned a recovery plan for Africa and is putting it into action. I caught up with James Mwangi to discover how he's going to do it.
Thank you very much, Zain. We learned a couple of things. The first one is how fragile the African economy was. The second one is how dependent it was on global supply chains. And the third one is the vulnerability of people. And the vulnerability of people became very, very pronounced when you looked at the increased poverty levels, the disruptions of livelihoods, and disruption of business. And we also lastly realized that the African continent or the African economy was over-dependent on the global economy and had no much headroom, particularly on fiscal and monetary policy. As a result, when crisis hit, the governments didn't have enough room for maneuver and could not carry out expansionist policies that would have acted as stimulus to recover the economy. So it has been a long journey. However, one thing also came out that the economies, despite how fragile they were resilient and could easily be built back better. So we saw the entire African economy going down by 2.4% of its GDP, but projected to grow at 5% this year.
James, how have you combined the force of Equity Bank and Equity Group Foundation to help with, on the business side, on the development side, to help Africans during the pandemic? How has that actually worked?
Equity from the very beginning is a purpose-driven organization with the two engines, an economic engine that sustains it and scales it, and a social engine that focuses on and centers on people. So the purpose of the bank is to transform lives, give dignity, and expand opportunities for the African people. And the two engines reinforce each other and play into each other. The social engine ensures nobody is left behind and that equity remains centered on people. It's a people-centered business, and that nobody is left behind. The economic engine sustains, scales the business, and bring sustainability into the business and provides for the cost of the entire business. As a result, equity is built around the core of the economies, what you could call lead economies, the economic activities that sustain populations. It is a community-based bank as a result of that. So when COVID struck, what Equity did was really then to use the social engine to try and save lives, uphold the dignity of the people despite the challenge, and sustain the lights of the economy on so that the economy could continue to provide opportunities for the people. That involved reducing as much as possible vulnerability and probability of any enterprise going down. So that's how we managed that. On the economic engine, we provided rescheduling of loans to ensure that we brought repayment to when cash flows were back. And in the process, we saved almost all the businesses that were in equity.
In your recovery plan for Africa that you've designed, you really focus on trade as a way to engage SMEs and create wealth while reducing poverty. Could you just explain to us how it will work?
We realized that our governments were challenged in the 6 countries we are operating in. Their debt to GDP ratios were in the up of 70, and that debt was proving unsustainable. We felt as a leading organization and financial service provider, we were well positioned to mobilize our partners and collaborators and try and drive a post-COVID recovery and transformational plan. That involved us signing to the framework of the East African Community, integration and cross-border trade, signing with the African Union for the African Continental Free Trade Area, and then signing with the governments on priorities for each of the countries and incentive schemes, and then with the United Nations so that we could use the Sustainable Development Goal framework, and then teaming with the international development banks. So Equity has rolled out $5 billion to be given to 5 million enterprises each to create 10 jobs and hence create 50 million jobs in the next 1 year. And the risk is shared with the UN agencies through capacity building so that we can de-risk the effort and long-term lending to the development banks.
And how does that recovery plan focus on a sustainable green recovery? What does that look like to you?
It is purely centered on building back better. We're not rebuilding the East and Central African economy the way it was. And we felt that in building back better, the central focus will be on clean energy. So what we really done is to guarantee the use of sustainable clean energy and remove of the second aspect is afforestation to guarantee recovery from a climate perspective. So that is where the focus has been, to ensure the recovery is green.
James Mwangi from Nairobi. Asante sana. Joining me now is Claire Akamanzi from Kigali. Claire, it's so good to see you. Let me start by asking you this. How much has the pandemic rolled back the progress Rwanda has made over the years?
Very nice to be here with you, Zain, as well. So the pandemic has had negative effects on our economy, just like many economies of the world. If you look at 2019, Rwanda was among the fastest growing economies in the world. We grew at 9.4%, and we had an 8% growth on average for the decade before 2019. And then in 2020, we contracted by 3.4%. It was the first time our economy was contracting in years. Almost since 1994, we had never had a contraction like we saw in 2020. But the good news is that as the vaccines are beginning to roll out, we expect that by 2023, our economy will roll back and get back to the pre-pandemic days. And we expect positive growth to start this year, but to get back to that stage pre-pandemic by 2023.
What's the recovery plan for Rwanda looking ahead?
We are betting on manufacturing because the key with manufacturing is that the domestic market is very important in consuming the products from the manufacturing sector. And so compared to the services, if you look at our strategy before the pandemic, it was very much based on attracting tourism, conferences, among others, which were very much dependent on external consumers. So this time, our key recovery plan is going to be around manufacturing. The second one is going to be a different type of tourism that we think can survive within the context of the pandemic. So tourism, for example, while we can have conferences on Zoom, sports events need to be done mostly physically. We just hosted with the NBA, the Basket Africa League, and we had a very good number of people, almost 1,000 coming to Kigali to attend the NBA, and we had to manage that within the context of the COVID-19. So sports tourism is going to be very important. People are beginning to travel again. Our aviation sector is picking up very strongly as well, as we see people beginning to travel. We get about 1,000 people on average leaving Kigali or coming to Kigali. So that's going to be a key sector for growth. So services sector is going to be managed within the context of the pandemic, but we expect that real recovery will come from manufacturing and agriculture. So those sectors are the ones we're looking at right now.
Claire, has Rwanda's sponsorship of Arsenal football team paid off as anticipated? I mean, you were the architect of Visit Rwanda and that whole enterprise. Did it pay off?
Visit Rwanda is becoming a well-known brand. If you look at the sleeves of Arsenal, the PSG, and now the NBA Africa League, all show Visit Rwanda. So it's been a really good brand. If you look at the impact in 2019, when we had just started to see the benefits, Rwanda's tourism grew by 17%, which was the highest growth year on year. And then just from the UK, where the biggest market for the Visit Rwanda brand was, it was 22%. But of course, the pandemic interrupted what Visit Rwanda was going to benefit from these partnerships. And now we are reimagining how this partnership is going to support a recovery of tourism post-pandemic, and that's what we're looking at. But already 2019 showed it was the right thing to do.
I didn't hear you mention aviation, and I know that that is also really important for Rwanda. You have an important relationship with Qatar to build Rwanda as an aviation hub. Can you talk to us a little bit about that partnership and where you're at with it? And also how you see Rwanda as having a competitive advantage over places like Joburg, for example, Addis, and of course, Nairobi?
Well, first of all, Rwanda and Qatar enjoy an excellent bilateral relationship, which is really important. And building on the excellent relationships we have with the state of Qatar, we also have economic ties that we're putting in place. And I think the key one is aviation. We have a partnership to jointly build a new airport called Bugesera Airport. We have a partnership to co-own Rwanda. And this is really important because this partnership is going to allow Rwanda and our aviation industry to go to a whole new level. Qatar Airways comes with a lot of strength, financially experience, expertise. Rwanda has a lot of knowledge and experience working within the African continent. And this relationship of the two parties is very key. And I think it's going to really take the aviation sector to another level. Now, what makes us competitive? First of all, even though we have other hubs on the continent that are doing aviation, the need for this market is very huge. If you look at the share of Africa, whether it's trade or investments or tourism, it's just a very small percentage globally. It's always around 2 to 3% in almost every segment. The need is big, it needs more players. So one player, 2, 3 cannot be enough. And that's why Rwanda are coming with Qatar Airways to strengthen and position ourselves, is just making sure that there's more opportunities for a very big need the continent has. But for Rwanda specifically, what makes us competitive? The first thing is our location in the middle of Africa, connecting West, Central, and East Africa. Our location makes us competitive. But secondly, our policies. We are among the few countries in Africa where anyone in the world can travel to Rwanda without having to get a visa before they arrive. Any citizen, whether you come from Jamaica, or you come from Africa, or you come from Europe or South America, you can get a visa on arrival. And that makes it very easy for us to connect people because the policies allow for that to happen. And of course, the infrastructure we're building, whether it's the airport and the airlines. And so I think we've built a very competitive ecosystem, and we continue to invest in a very competitive ecosystem that just makes us have a good bet, but also a real chance in competing for this sector.
And you're also wanting to play in another space. You're setting up Kigali International Finance Center. What makes you think that you can compete as a financial center, for example, with Johannesburg?
It's easy to do business in Rwanda to start with. Today, Rwanda is the easiest place to do business in Africa, only after Mauritius, and we're 38th easiest place to do business in the world. That's the first thing. Secondly, as I said, the need is so big. If you look at the investment opportunities the African continent has, a lot of opportunities still exist. And Rwanda has put in place the policies, the laws, the regulations that make it really work for us.
Clara Kamanzi, thank you so much. Claire, I need to make it soon to Kigali and then hopefully one day name a baby gorilla. I'm overdue.
Zain, you can count on that. Very welcome. And I hope many people that are watching this can also come to Rwanda soon.
I'm David Malinga, Bloomberg East Africa Bureau Chief, and I'm joined today by Mr. Mohamed Dewji, the president of a Tanzanian conglomerate, METL. Mr. Dewji, thank you for joining us today. What would you tell investors seeking opportunities in Africa despite the toll of the pandemic in the region? And what sectors would you be advising them to bet on?
Yeah, so first and foremost, the COVID issue has been very difficult all over the world. But fortunately, in Africa, our population, average population, is less than 20 years old. So we have a young population, a growing population, and obviously their immunities are high. We don't have proper statistics because, we didn't have PCR tests. There's not a lot of testing that is happening. But in general, I feel that COVID, besides South Africa, has really not hurt many economies in Africa. That's number one. But number two, your question regarding that, what are the opportunities? You know, when I look at, you know, the West, Europe, the United States, they have the capital, they have the money. What Africa needs is capital. And there's numerous opportunities in Africa. You talk about infrastructure, there's opportunity. You talk about agriculture, there's a concept of Africa being, you know, the breadbasket of the world. You talk about agri in all sense, you know, whether it is food related, non-food related. So in general, I feel that we need capital, opportunity is there, growing population, you know, GDP growths are fantastic. Finally, we're getting good corporate governance. You know, if we can cut the red tape, I think that this is, you know, a perfect match.
Yeah, and specifically talking about Tanzania, you know, your country, the economy has been one of the fastest growing on the continent. What kind of investments, particularly, do you see playing out well in Tanzania, and which, you know, can promote a sustainable growth for not just, you know, for both the country and then the investors who are coming in?
Yeah, so, you know, fortunately, I'm running a business. I'm employing 31,000 people. I do trading of commodities, but I'm also into a lot of manufacturing. So I have over 50 industries. I compete with Unilever, Procter & Gamble, Coca-Cola, Pepsi, et cetera, et cetera. There's big opportunities. We have so much raw material and resources. Textile, cotton textile in Africa. And I have mills that do ginning, spinning, weaving, processing, mercerizing, dyeing, printing, knitting, and garmenting. And what impact that creates is big jobs, one. Two, we have cashew nuts, where we export raw cashews, where we can potentially put processing plants and employ hundreds of thousands of people. Or three, agriculture. There's a business that I do, it's called sisal, which is a semi-drought resistant crop. And I will be the largest single sisal producer in the world by 2022. So opportunities on agriculture is there, manufacturing is there, infrastructure is there, tourism is there. So I think there's great opportunity.
For merit. It's been the fastest growing economy. What type of investments do you really see presenting that opportunity for inclusive growth? And I'm really talking about jobs here for the young people.
Yeah, so I want to give my own example, you know, that over time, we've been a trading house. We've invested heavily in manufacturing, fast-moving consumable goods. So I compete with the Unilevers, the Procter & Gambles, the Coca-Cola, and the Pepsi. So manufacturing space, big opportunities and big value addition. And when you talk about value addition, you know, you don't want to export just gin cotton, you know, you want to export finished goods. So I have invested heavily in textile mills where I do ginning, I do spinning, I do weaving, processing, mercerizing, dyeing, printing. And we are competitive because labor is competitive, power is reasonably competitive, we have local raw materials. Similarly on cashew nuts. I mean, this country is exporting 90% of raw cashews. So if we can increase and process cashew into cashew kernels and export straight to the United States, big opportunity.
Yeah, thank you, Mr. Dewji. And over the past, 5-6 years, we have seen a lot of government investment in Tanzania in terms of infrastructure, probably not as much in terms of private business, which leads to my question, what do you see as the future of investment in Tanzania in the next 2 to 3 years?
I think, the projects are big. We have few projects. We invested in airlines for connectivity, for tourism. We want to increase the number of tourists that come to Tanzania because of Serengeti, Ngorongoro, etc. But our new president, she's fantastic. I mean, we're going to continue building the rail between East and West. We all know the rail is the cheapest mode of transport. Per capita income is small. So in short, by, transporting goods cheaply, that means it gives more money in terms of purchasing power to Tanzanians. And 3, we want to be self-sustaining in terms of power generation. And there's a $7 billion project. Past the government was more involved in trying to do business. I think our new president, she just wants to create an conducive environment that we invest, we create jobs, and we pay taxes.
All right, thanks. And then lastly, just talking about your business,
So interestingly, you know what, COVID deniers, number one. And number two, there was no lockdown whatsoever. So, my business has grown year on year, almost 15 to 20% in revenues, job creation. We've jumped about 4,000 or 5,000 people. So we have actually not felt as a company, because I'm into the manufacturing. You're talking about the bottom of the pyramid. As a country, yes, tourism has been affected, but in general, I think Tanzania has been very least affected by the pandemic.
Thank you, Mr. Dewji.
Thank you very much.
Thank you for watching this session. Hopes are rising for a return to some semblance of normality in the global economy. We want to create a recovery that works for everyone. Stay with us.
Thank you.